السلام عليكم ورحمة الله وبركاته. أسعد الله مساكم بكل خير. سعدنا في الهيئة السعودية للمقيمين المعتمدين تقديم هذه الورشة بعنوان تقييم الآلات والمعدات لغرض إعداد التقارير المالية. سيكون معنا المتحدث السيد دوقلاس كريسير. السيد دوقلاس هو المدير العام لشركة فالكون وشركائه للتقييم، كما شغل منصب الرئيس السابق للجمعية الأمريكية للمقيمين أو الجمعية الأمريكية للمثمنين ASA. السيد دوقلاس يمتلك خبرة أكثر من 18 سنة في التدريب وتقديم الدورات التدريبية في التقييم، كما يملك خبرة أكثر من 36 سنة في التقييم. يمكنكم المشاركة معنا حضور الجلسة أو حضور ورشة العمل عن طريق اختيار الترجمة، قناتي الترجمة، إما باللغة العربية أو باللغة الإنجليزية. ستكون بداية الورشة من 3:30، ثم سيكون عندنا فترة استراحة عند الساعة 5 مساء لمدة 15 دقيقة. بعدها سنتابع هذه الورشة حتى نهايتها بإذن الله. Good morning, Mr. Douglas.
Good morning, everybody. Good morning. How are you? Hope all is well.
Welcome to our workshop here at Taqeem. You can start your presentation, please.
All right. Thank you, Mustafa. Well, welcome, everybody. The topic for today is valuations for financial reporting, and this is the IFRS version. I've got another version of this that is set more for the United States. This is going to be a rather long presentation. We're scheduled for 3.5 hours. We're going to take a break about an hour and a half in. And don't worry, you will be getting a student manual. I've been assured of that. I guess it is just being translated now into Arabic so that everybody can understand it properly. So what are some of the topics we're going to cover today? We're going to cover 5 basic standards that apply to us as machinery and equipment and tangible asset valuation personnel. Those are IFRS 3 business combinations, IFRS 13, which is fair value measurement, and we'll go into that in some detail, IAS 16, which is specific to plant, property, and equipment, IAS 36, which is an impairment of assets, and IFRS 5, which is non-current assets held for sale and discontinued operations. So there are lots of standards that are put out, but these are the 5 that really apply to us. Now, we're not going to go to them in any significant depth. We're going to go them just in the amount of data that we need and the detail that we need. I would encourage you to get a copy of them. They're very, I wouldn't call them interesting reading, but they're very valuable. And if you go to ifrs.org, which is the IFRS website, you can get a download, and I think it's somewhere around 315 British pounds. So we're going to go briefly over these different topics. These are the real topics we're going to cover today. I'm not going to go through them in any detail now because we will be going through them as we go through this webinar. There's a lot to cover. As I mentioned, you will be getting a student manual. The positive thing about the student manual is it's going to follow the slides very closely. So you will have a great reference material when we're done with this. We're going to go over some data on the slides. We'll go over some of it that I'd like you to go over yourself later on. I will try to hit the key parts of each topic so that they are understandable to everybody. I understand that Mr. Mohammed is doing a translation for me. So I will try to talk slowly, which, as Ruka knows, is something difficult for me to do. So I will do my best. So before we kind of get into the topics that we need to discuss, we need to go over some terms that everybody needs to understand. These are terms that proliferate through the different standards, and as a valuer, you need to understand them. The first one is an acquiree. Now, I'm not going to go over and read the definition of the acquiree, but let's just say that the acquiree is typically the seller. That is the company that is selling their business. The acquirer is the buyer. Now, when you're doing work under these standards, more often than not, you are working for the acquirer, not the acquiree. That doesn't mean you won't ever do work for the acquiree. I've done work for companies selling, but most of the time, you're doing work for the company doing the buying. So just understand the difference between acquiree and acquirer. This next term, acquisition date, is extremely important for us. The acquisition date becomes your valuation date. So the acquisition date is the date of the transaction. Now, one thing you've got to keep in mind, and we'll talk about this later on, is the fact that a transaction happens, two companies merge, one company buys another, an acquirer acquires an acquiree, and all of a sudden they go through and do their things, and somewhere along the line, they get told they have to do a valuation. So are you going to be doing the valuation as of the acquisition date? Most likely not. Most likely, you're going to be doing the valuation later, which means your valuation will be what's called a retrospective valuation. So it's very important that you understand the acquisition date. And we'll talk a little bit more about that later. The next term is another term that's important, is business. What a business is an integrated set of activities and assets that is capable of basically, and boiling this down to what is the most, the basics, is a business is an integrated set of activities and assets that generate income. That's really what a business is. So a business is a group of assets that generate income. A business combination, which is kind of what we're here to talk about today, is when two businesses merge, or one business buys another business. So that's something that we're going to talk about over and over and over again. IFRS 3 covers what's called business combinations, and we'll go over that in some detail. Control, I'm going to skip legal entity. You can read that on your own. Control is what happens when a business combination happens. Typically, it's not a merger of equals. Typically, one company gains control over the other, and they gain what's called equity interest. So they gain ownership interest. So usually, if you do a merger of two companies and they're equal, that is something else, and that's not necessarily a business combination. That's more of an agreement that typically is not covered under these accounting standards. But usually, one company takes control over the other and gains equity interest of that company. So we're going to dig a little bit deeper into what a business combination is. What is a business combination? So a business combination takes place anytime an entity acquires the assets that constitute a business. So anytime somebody buys something that is a business. So if they purchase 3 or 4 pieces of equipment, they have not done a business combination. They've just purchased assets. In order to do a business combination, they have to purchase an entire business. It happens also, looking at the second bullet point, anytime an entity acquires the equity interest of one or more entities and control over that entity. So again, going back to those terms, anytime somebody takes control or obtains equity interest, it's a merger and it's considered a business combination. Anytime one or more entities are merged or become subsidiaries, so when companies merge, sometimes they're both at the corporate level, sometimes one takes a subsidiary level, and the parent company gets to be the main company. Anytime one entity transfers the assets of his ownership or equity interest to another, or anytime all entries transfer net assets or ownership to a newly formed entity. So you might have two companies that merge, they might be equals, but they will put up a different company name and they will form a different corporation. So pretty much anytime a business buys another business, we have a business combination. Now, one thing I want to be very clear up front, for the most part, the companies that follow these standards are publicly traded companies. They have to follow these standards. They have no choice. Sometimes private corporations or companies that are owned by private individuals follow these standards, but they do it voluntarily. But if they do it, they still have to follow the same standards. So now that we've kind of got that clear, we're going to talk about the main reason we're here today. We're talking, believe it or not, we're going to talk about 3 hours over these 2 words, fair value. I know that sounds kind of crazy, but that's what we're here to talk about today, are the words fair value. So I'm going to read the definition, and we're going to go into some of the key components of that later on. So fair value is the price that would be received to sell an asset. So you buy an asset, or paid to transfer a liability. So you sell an asset, but you basically buy a liability. So an asset is a positive, a liability is a negative. In an orderly transaction, and we'll talk about what that term means later, between market participants, and we'll go into that pretty deeply, as of the measurement date. Now, I mentioned another date earlier. I called it the acquisition date. The acquisition date is the same as measurement date. Why they decided to come up with 2 different terms? They're accountants. They want to make things a little complicated. So they have 2 different terms. But measurement date and acquisition date are the same. Another term that's very important to this whole area of valuations for financial reporting is goodwill. So goodwill, and we'll go into this deeper later, but I'm just going to read the definition, is an asset representing the future economic benefits. So it's the benefits you're going to receive arising from other assets acquired in a business combination that are not individually and separately recognized. So goodwill is the economic benefit you get from buying assets. And again, we're going to go into detail about what that is later. Tangible assets are personal property and real property. Intangible assets, I'm sure, I think a lot of people on here have got some familiarity with business valuation. Business valuation folks are primarily the people that do the intangible assets. So they're an identifiable, non-monetary asset without physical substance. What does that mean? So what does that word identifiable mean? Identifiable is an asset that is identifiable if it meets the following criteria. So it has to be separable. That is, you have to be able to separate it from the business, and you have to be able to sell it to somebody else. So how can an intangible asset be sold? Well, think about this. What about a patent? What about a copyright or something of that nature? That is an identifiable, separable asset. It's something that could be sold. So an intangible asset is something that, although it's not physical, could be sold. So that's all we're going to talk about on that standpoint. Again, I'm trying to bring this into what we do as tangible asset folks, but there's a certain amount of intangible asset nomenclature that we need to understand in order to go through this. So financial reporting, I'm sure everybody's heard this. We're doing valuations for financial reporting. Financial reporting is the process of preparing an entity's financial statements in according with the international accounting standards or the generally accepted accounting practice. So just so you know, and I'm sure everybody's cognizant of this, the generally accepted accounting principles, or GAAP, used to be pretty much all of North America. Now it's pretty much, the United States. Canada has got certain provinces that use GAAP, but they're kind of moving over to the international accounting standards. Mexico is moving over to the international accounting standards. As far as I know, all of Europe and Asia and most of your countries in the Middle East follow the international accounting standards. So GAAP is kind of shrinking. And I think the United States realizes that. And one of the things they're doing is they're taking the IAS and the GAAP and they're making them very similar. So I just want to let you know that financial reporting is the process of producing a financial statement. Now, one of the things that's very important is I've often been told doing financial reporting valuations is not appraisal, it's accounting. I disagree with that because we are doing actual appraisal, but I think we're held to a higher standard because the values we put on our appraisal end up on the financial statements. So it's very important that you take this very seriously because they're going to be put up there for everybody to see. Now, why do we even do this? Why is there a reason to do this? So when two companies merge, each company has different buckets of things. One of it is the intangible assets. We talked about that a little bit. That's things like patents, copyrights, workforce, things of that nature. Sometimes they own real estate, sometimes they lease, but that's another bucket. Personal property includes what we do, which is machinery and equipment. It includes inventory, it includes artwork, it includes things of that nature. I'm going to jump across the pie over here to net working capital. That's basically cash, stocks, investments. And then there's goodwill. So if you look at the purple, the red, the yellow, and this kind of greenish thing, the greenish pie pieces, that's what we value as appraisers. The yellow piece, the goodwill, is what's left of the pie. So why do we even do this? And again, the question is asked, why do we even do financial reporting evaluations? Well, first of all, the new business enterprise, which is the merger of the two businesses, has a right and the ability to redepreciate the various assets. Now, again, that depreciation is an accounting term, not a valuation term. So as you know, we do depreciation, physical, functional, economic. Accountants do recovery depreciation. So as a buyer of a company, and Muhammad, I'm sorry if I'm speaking too fast, hopefully I'm doing okay. They get to re-depreciate their assets to give them a tax advantage. Also, the accounting standards dictate that this has to be done. And thirdly, it also recognizes intangible assets that previously were not capitalized. So if you are a company and you have not been purchased, there are certain intangible assets that you as a company cannot recognize and you cannot capitalize. I'm not going to go into the rules on all that. I don't understand it. That's way above my ability as an appraiser. Remember, I'm just a machinery and equipment appraiser. Some people would think I'm not very smart. I tend to disagree. I'm somewhat smart. But there are certain things that you can only recognize when a transaction occurs. So what we're doing here as a team, and we'll talk about that valuation team later, is we're putting together all these things. In many cases, the client has to do that. They have no choice. Again, we talked about earlier, the accounting standards dictate. Dictate means you must do this. So therefore, your client's going to call you when they're going to say, I got to have this done. I want you to do it as efficiently and cost effectively as possible. Does that mean cheap? No, that means cost effective. So I'm often surprised at, when people call me and they say, I need to have this done, and I give them a price and they're like, that's ridiculous. And I'm like, I'm sorry, you've got 20 plants throughout the United States. That's a lot of work. Or you got 3 plants that we got to send 3 different individuals to. It all costs money. We're not doing the same thing as a real estate appraiser who's got one asset. We're doing tens or hundreds or thousands of assets. So just to let them know that sometimes that's what it costs to do business. The acquirer, remember the acquirer is the buyer. Their ultimate goal is to have an updated fixed asset record. I'm sure that term is somewhat familiar to you, but we're going to go into that in the beginning going forward. So what you're doing is you're helping them come up with values, but you're also helping them come up with, what they bought. I often get asked by an employee when I'm going through the process of the plant, and if they know that a purchase happened, they're like, what are you doing here? And I said, well, I'm trying to figure out what the parent company bought. And they're like, don't they know what they bought? And I usually point at them and I said, well, they bought you and they bought this. They bought the company. So they know what they bought. They bought you and they bought the product you're making. But my job is to say, what did you buy? What little components did you buy that make up that product that they bought? So companies don't buy machinery. They don't buy forklifts. They don't buy a process piece of equipment. They buy a product. So they know what they bought on the aggregate, but our job is to give them the minute detail of exactly what did they buy. They want to start to depreciate their acquired assets. They also want guidance on remaining useful life. And believe it or not, they're going to look at you to give them that remaining useful life. We're not going to go into detail now how to calculate that, but that's something you need to know. So your client's going to use the remaining useful life. The person doing the business enterprise value is going to use it remaining useful life as well for some of the things that they're working on. So what does the client want and why did they hire you? So first of all, the auditors are going to want to see some sort of tie, some sort of a bridge between the closing balance sheet of the old co, I'm calling it, which is the company that got sold, and the opening balance sheet of the new co. So you've got values here, you've got values here. They're going to want to see what was that bridge between the two. So more often than not, the best place to start, and I'm going to say this with a big caveat, the best place to start is the fixed asset records. But you got to be very careful. And we'll talk about some of the things you got to be careful about later. And I know we're going over a lot of information. All the text you see on the slides will be in the student manual, so don't worry about that. So how do we make that bridge and how do we do that? That's kind of our job. They want to see the extent of the write-up. So what they call the write-up is the value over the net book value, or in the accounting standards, again, accountants like to use fancy words. They call it a carrying value. So the carrying value is the net book value. Now, for those of you who have been in this industry for a while, you know that more often than not, the value we come up with is going to be somewhere between what they paid for it and net book value. Is that always the case? Sometimes it's not, but 80% of the time, maybe 75, 80% of the time, the value we come up is between the two. So the accountant and the company are going to want to look at that. So what you're going to want to do is somewhere along the line in your report, you're going to want to show a relationship either by asset or by major category of the historic or original cost. And I'm not going to go over the differences. I know I've looked at some of the Taqiim courses. I know that they do go over historic versus original cost. There are probably several people on this today that have taken the ASA courses. We hit that very, very hard. So they're going to want to, your accountant and your company is going to want to see what is the historic cost of the assets, either individually or as a group. What is the net book value of those assets? And what is the fair value of those assets? Now, again, that does not have to occur on an asset by asset basis unless your client requests that. But somewhere along the line, you should have a summary that has that kind of breakdown. What else do they want? Well, they want a valuer who has experience in dealing with other valuers on the team. So we're going to go over this, and I'm hoping we have some time. We've got a lot of data to cover, but I'm hoping we can go over this. This is a team event. You're going to have business valuation, you're going to have real estate, you're going to have inventory, you're going to have machinery, and they want an appraiser that plays well with others. I don't know if that's something that you say in Saudi Arabia, but in the States here, that's kind of a common term of they play well with others, they work well with others, they understand how all these different valuations kind of come together. So the better you are at doing that, the more of this type of work you're going to be able to do, because the easier it's going to be for you and for the client. They want a valuer who's familiar with the appropriate standards. You'd be surprised how many people try to do this work and they just don't get it. So what are the different things you've got to look at? You've got to look at the proper premise of value, which is fair value. We'll talk about that coming up. So you need to understand, what does fair value mean? you need to be able to do your proper due diligence. You need to look at things like, is it a bargain purchase? And again, bargain purchase might be a new term for you. I will go into what that means a little bit later. They want to be able to understand, are you handling obsolescence properly? Are you using the market to come up with your numbers? Fair value is a market-driven number. Now, I'll explain what that means later. It doesn't mean you can't use a cost approach, but it prefers that you use a market. It prefers that you create what's going on in the marketplace. The other thing that might be a problem is that the appraiser does not have a detailed enough work file. And we'll talk about that later. That's huge when you get to the audit, is your work file sufficient? The auditor needs to keep digging and asking questions over and over and over again. If they got to keep doing that, then you got a problem. So they want a valuer that understands the standards. They want a valuer that goes through the audit process quickly and efficiently. Auditors cost money. I don't know what it's like in Saudi Arabia. I don't know what your fee structures are like. But here in the United States, auditors typically charge more per hour than appraisers do. And clients get very upset when the appraiser starts costing them a lot of money because the auditor has to go through a lot of issues. So they want somebody that knows what they're doing and can work well with auditors. So we talked a little bit about this briefly, that you want to work with the fixed asset records. And we talked a little bit about the benefits and why. But you've got to look at, when you're looking at the fixed asset records, there's some things you've got to look at and some caveats that you have to concern yourself with. So first of all, do you work with the tax books or the financial books? Now, again, I don't know in Saudi Arabia. I'm assuming that you've got a very similar system where a company has two sets of books. They have one for tax accounting and one for financial accounting. You want to make sure that you're starting with the financial books, because those are the ones that are going to have the data that you need. The tax books may have different lives on it. They may book different things different ways, but you primarily want to start with your financial books. So when you're talking to your client, you want to make sure you get their financial books, not their tax books. You also want to make sure that the asset records that you have are as of or close to that acquisition date or the measurement date, because that's your valuation date. So why is that important? Because again, you might be doing a retrospective appraisal. And if you're doing a retrospective appraisal, there's a lot of things that you need to consider. And we'll talk about some of those in a little bit. But you need to make sure that you don't have assets on there that are past the valuation date. And you want to make sure that all the assets that you have, if there's any disposals, that you value them as of the appraisal date. Now, if they disposed of something, you may take a different approach to it, but you got to make sure that that's on that asset record. So we talked a little bit about that. You need to review the fixed asset record in order to get an understanding of the various entities. Understand the data that you are given. They also need to assess the validity and usefulness of the fixed asset record. So if you have a fixed asset record that just has, and I've seen this, machinery in 2010, machinery in 2011, machinery in 2012, and that's the only description they have, and they have a number and a date, that's really not that easy for you to use. The asset records have to be something that are understandable to you and that are something that is meaningful to you as a starting point. If the records are not meaningful to you as a starting point, or they have not been reviewed, that's another thing I always ask my clients to do, is review the fixed asset records. Get rid of all the stuff that's no longer on there, or at least help me get rid of it. My job as an appraiser is to go through the plant and identify the major assets and make sure that they're on or not on the fixed asset records. But my job as an appraiser, depending on what you're doing, is not to look at every chair and every computer and every minor asset. That's a job for the client to do. So there will be cases where you're not going to start with a fixed asset record and you're going to go through and do a complete inventory. But then somehow, again, like I said earlier, even if you do a complete inventory, you need to put your fair values, at least a summary of the different categories that are on the fixed asset records, so that people understand the relationship between those. Now I see that we've got a couple of potential questions coming up. I'm planning on a break about maybe an hour from now or an hour and a half from now. So we'll try to answer any questions at that time. Unless Ruka, unless there's something that's really pressing, and if you see something that's pressing, please let me know and I can answer it now. But if it's not a pressing question,
Douglas, you can proceed. We'll attend to them before break.
Okay. So we will answer questions at the break unless there's something really critical. So we talked about this a little bit earlier. It's very critical to know the run date of the value of the fixed asset records. When I say the run date, what is it? That's the as of date. And again, you want to make sure that that as of date is as of the date of the transaction. So even if you got to go back to the accountant and say, I need a record from 10 months ago or 11 months ago, start with that record. Hopefully they can do it. If not, you're going to have to do some, you're going to have to be very careful not to value things that came in after that, and make sure you value things that happened before that. So you need to be able to go through the records, and part of your job, believe it or not, is to make adjustments to that record. Now, when I say adjustments, I never, ever, I used to, but I got into trouble doing this because clients yelled at me, so I stopped doing it. And I mean, hopefully you'll learn from my mistakes. Do not ever take assets off the fixed asset record. Do not remove them. What you want to do is you want to identify assets that are no longer there or that you didn't value, leave them on the fixed asset record. But what I do is over in the column where you have my fair value, I'll put a little descriptor, and it doesn't have to be anything major. Asset disposed, asset no longer exists, asset valued with the main assets, something like that. Let them take the assets off. Don't you ever adjust them. Also, never adjust their categories. They've got things categorized for a reason. You're going to categorize them differently, but let their main categories stay where they are, and you just resort the asset record the way you need it for the valuation. But then when you give it back to them, put it back in their order. So let me give you another little hint. Whenever you get a fixed asset record, always put an original order number and number it 1 through 1,000,000 or 1 through 10,000 so that you can get it back to the original order, because that's the way they're going to want it back. So, you know, I said there's some caveats when you're looking at a fixed asset record. And yeah, this list is small because there's a lot of things you have to look for. So what are some of the things you have to look for? We're not going to go into great detail. And actually, Ruka was asking me if I'm teaching any courses coming up. Coming up in December, I hope I'm going to be teaching ASA 215, which is financial reporting from the US side. Now, we're going to cover some things we're covering in this presentation, but we're also going to go into some details on how to handle things like these. So one of the things you've got to look at is partial or installment payments. What does that mean? That means that when they buy a piece of equipment, they may capitalize it in 3 different chunks. They may capitalize it as the down payment, and then later they made another payment, and later they made another payment. So all 3 of those things are actually one asset. So as a valuer, what you want to do is you want to value it as one asset, not breaking it up into chunks. You want to look at allocated values. When you do a fair value valuation for financial reporting, you're allocating the values. Now, if you've got allocated values or used costs, you're going to want to find out if you can get back to the original costs on those assets. It's very important. You cannot trend, you cannot depreciate allocated values. Allocated dates. Maybe they didn't change the values, but they put all the same date of the acquisition date on there. You need to understand, was that done because of a previous allocation? Were there assets that are purchased used? That's very important because you cannot do a cost approach. You cannot trend and depreciate assets that were purchased used. You have to take another approach. Are there ghost assets? What a ghost asset is an asset that's on the fixed asset record, but is no longer on site. So again, you want to be able to identify those. Don't take them off, but identify them and say, you know, disposed or sold or something of that nature. The opposite is true, and I see this a lot, where they purchase assets that somehow never make it on the fixed asset record, but they should be. But we're not talking about cheap things here. We're talking about expensive things. Why they're not on the fixed asset record, not up to me to ask. But I found, you know, you can find machining centers that are hundreds of thousands of dollars or $30,000 or $40,000 that are not on the fixed asset record. So part of your diligence is to identify assets on the record that are no longer there, but also to identify major assets, or as the accountants call it, material assets that are not on the fixed asset record. What about descriptions that are not easily identifiable? Lathe, CNC machine, car. What good's that do you? It doesn't do you very good, but somehow you got to be able to do due diligence. What assets are actually groups of assets? Again, I mentioned earlier, machinery 2010, machinery 2011. You got to figure out how to break those up. Misclassified assets, I've seen machinery or computers in the furniture category, equipment in the building category, building assets such as air conditioning and stuff buried in the machinery category. Again, don't recategorize them from their standpoint, but know what to do with them. Entries that are actually rebuilds or repairs, again, those are something that you really need to value with the asset itself and not individually. So again, we spend several hours on this in the ME 215, and sometimes this can be quite the chore to do. It takes a lot of interviews, sitting down or talking to the financial people, but also sitting down and talking to the operations people. Because I'll be honest with you, a lot of financial people never step foot on the operations floor or don't know what they really have. I've gotten so many times I've gotten the, oh, our records are fantastic. And then I start talking to the operations people and they say, accounting records are not good. Usually they use something that's a little more colorful, but I'm not going to say that here. But they say that the records are basically not good. So we got to go through and kind of rebuild the records. So now we're going to kind of dive into the standards themselves. And again, we're only going to cover the components that directly affect us. There's quite a bit of more detail. Each one of these standards is hundreds of pages long. I read them, so you don't have to. But again, I would suggest that you try to find them because there might be good references for you in there. I'm not sure if they're in Arabic yet. They might be. I wouldn't doubt it if they might be, but who knows? So now we're going to dive right in, and we're going to dive into the first one, which is IFRS 3, which is covering business combinations. So why did IFRS 3 even come about? Well, IFRS 3, which is the same as ASC 805 in the US, started back in the 90s. And the whole idea there was to improve the relevance and faithfulness of the information that they report in their financial reporting standards. They wanted to better reflect the investment made in the acquired company, allowing more meaningful valuations or evaluations of the performance of the investment. They want to improve the comparability of the financial information. That's one of the keys. And they want to provide more financial information through expanded disclosure. Now, that last part doesn't mean anything to us. That's really an accounting thing. But really what they wanted to do was they were going to say, if we have two companies that are essentially making the same product, I want to look at how are they performing as a company. Well, you can't do that if one company is reporting under one system and another company is reporting on another, and they're reporting different matrix or different measurements. So IFRS and our ASC 805 were meant to make sure that every company that does the same product are reporting everything the same. So it allows a more common basis of an investor or a company looking to buy a company to look at what happens. So the main goal is to apply the acquisition method to develop a common set of principles and guidance, minimize the exceptions, and basically clarify what assets should be recognized and require that everything is measured under the same valuation criteria, which is fair value. So they standardize the way you measure everything. So again, the way is, let's say you have a company in the United States and there's another company in Saudi Arabia. They're both doing the same process. They're both got the same kind of income level. Which one is performing better, or are they performing about the same? And maybe, one company, has got less assets, but they're making better use of those assets. How do you do that? Well, the only real way to do that is you're comparing two things that are the same basis. You're comparing them on the fair value of their assets. So here are a few things that apply to us as part of IFRS 3. So IFRS 3 applies to all transactions or all events in which one entity obtains control. We talked about that earlier. Obtain control, obtain equity interest in another business. It requires, that all assets be recognized as of the acquisition date at their fair value. So again, you see those words keep popping up. So as of the acquisition date and fair value. So you've got to look at what was the fair value of those assets as of that acquisition date. Now, acquisition date, again, is very important. Think about what happened during COVID. Some prices jumped. Some prices really fell for assets. But if you're doing a valuation in the middle of COVID and then you do one either post or pre, the valuations could be significantly different. IFRS 3 goes into something called the measurement principle. So what is the measurement principle? All it says, and again, there's paragraphs and paragraphs and paragraphs on this, but breaking it down to one sentence, it says that the acquirer shall measure the identifiable assets acquired, so they bought assets, and the liabilities assumed at their acquisition date fair value. It's pretty much the same thing we just talked about. Again, they like to repeat themselves because they want to make sure that everybody gets the idea. So for each business combination, the acquirer shall measure. Measure is another word for value. They shall value at the acquisition date the components of the non-controlling interest in the acquiree that are present ownership interests and entitle their holders to a proportionate share of the entity's assets in the event of the liquidation. So basically what they're saying is, for each business combination, you have to value what assets are you buying and what are the future benefits of those assets. If you really look at it, that's all this is really saying, is that you must measure or value as of the date of the transaction the assets and the benefits of those assets. So IFRS states that, in general, the fair value of the net assets acquired and the consideration paid are assumed to be equal. In other words, what they're saying is if I go and buy a company and I pay a certain amount for that company, that all of the assets of that company add up to that total amount. Now, under normal circumstances and an active market and everything of that idea, the answer is that should be the way it is. In some cases, it is not, but those are exceptions, and we'll talk about it. We'll talk about those later. So then IFRS goes into this, and it says these are the stages that you must do in order to do what we are asking you to do. These are the stages that you must do to measure the asset values. So first of all, you identify the acquirer. So who is the acquirer? Well, the acquirer to us is the client or the intended user of our valuation. They are the company that is buying the other company. So they're the intended user. You have to determine the acquisition date. Remember, we talked about the importance of the acquisition date. The acquisition date is a date that the acquirer obtains control of the acquiree. Excuse me. Apologize. It is typically the valuation date as well. Generally, you're going to get this as a retrospective valuation. So if it's a retrospective valuation, there's certain things that you, as the appraiser, have to consider. So you need to look at, what are my trends going to be? Making sure that you take trends that only go up to the acquisition date. When you're looking at market comparables, make sure that you're looking at market comparables as of that date. Make sure you get these proper asset listing. We talked about that several times. Looking at things like construction in progress or CIP as of that date. What were the vehicle mileages and hour ratings on mobile equipment as of the acquisition date? Not today, but going back in time. What assets were acquired or disposed of after that date? So there's a lot of things that you, as the valuation person, have to consider with that being an acquisition date. The third step is to recognize and measure the identifiable assets acquired, the liabilities assumed, and the non-controlling interest. So in other words, this is saying all this is really saying is, what is the purchase price? Is the purchase price the same as fair value? You as the appraiser is going to help determine whether the purchase price is equal to fair value or not, because you're going to figure out the value of one component of that, which is the tangible assets. The purchase price does not include transaction costs such as consulting, legal fees, due diligence, appraisal fees. All of that is something that's expensed, but you do have to take into recognition the acquisition fee. So many times when I'm talking to a business valuation person that's hiring me to do this, or I'm talking to the company individually, I will ask, what is the purchase price? And then somebody say, why do you need that? And I say, because I want to know, is this going to be a bargain purchase? And we'll talk about what that is later. And I want to know what they feel the fair value of all the assets are. You have to recognize goodwill, and we'll talk about that a little bit later. So looking at these steps, there's these 4 steps that you have to do. If you look at the International Valuation Standards, or in the United States, if you look at USPAP, this is very similar to what we do in pretty much every valuation we do. We look at who's our client, who's the acquirer, what's the valuation date, what's the value, or what's the premise of value that I'm looking at. Very similar to what we do. They go from that into what they call the measurement period. Now, the measurement period has very little to do with us, other than the fact that our client will call us sometime during that measurement period to do the valuation. And I say sometime, but let's talk about it. And I'll tell you a little something that's kind of interesting later on. But acquisition period is the time after the acquisition date that the acquirer is allowed to make adjustments to the entries that make up their financial statements. So typically it's a year. So they have 12 months to basically gather all the information together. Now, why does the IFRS and the United States, the SEC, Securities and Exchange Commission, why do they give a client a full 12 months? Well, you might buy a company, but then you might discover later that they've got another entity out there that nobody was aware of. Or maybe there's another asset sitting someplace that they were not aware of. Or maybe, more likely, there's a liability sitting out there that nobody was aware of. So this gives them a year to basically discover what's out there. Now, you as the person doing the appraisal are going to get called sometime within this year to do your valuation. And what usually happens? They usually wait till the end when their auditor goes, we forgot to tell you, you need a valuation done. So then what happens is that you get called and you say, you got to have your valuation done by this date. And sometimes it's possible, sometimes it's not. But just so you know, the measurement period is a year, and they're going to try to call you sometime within that year. Now, I've had appraisals come in after that. How they're getting away with that, I don't know. But they do that. After this year, the only way that they can revise for anything they do is to make either to correct an error or to make an adjustment. They don't like that because up until that year, nothing they do affects their financial books other than adding the values. And during that year, if they make corrections up or down, it doesn't affect their value, doesn't affect their books. But after that 12-month period, they've actually got to take write-offs or do write-ups, which does affect the value of the company. So it's very important that in any way you can, you talk to your clients and say, we got to get my stuff done because I don't want to affect my client. You know, I want to, I had a client that I just did a valuation for. Unfortunately, they're planning on moving most of the equipment from one plant to another, but it's going to be 2 years from now. So it's not going to be within that 12-month period of time. So I ended up having to value everything in use, which is going to kind of hurt them if they move this stuff early because they're going to have a huge write-off, but there's nothing we can do about it. I talked to the auditor and we said, we got to do it this way because that's the way the rules are written. They provide guidance on what's to be considered and what the applicable value standards are. It defines fair value. Just keep this in mind that no matter what you do for financial reporting, you must call it fair value. Now, you need to call it fair value, but in some cases, you may have to quantify what that means. And we'll talk about what that quantification is later. There's different terms. There's fair value in exchange, fair value in use, orderly disposition value. Those are all things that we will go about later, but they're all termed from fair value. Remember, I mentioned earlier that fair value is a market-based measurement and not an entity-specific measurement. It's based on what the inputs from the market are. The market meaning market participants. The market means what's going on in the marketplace and not specifics to this company. Before we move on, there's a few other terms that we need to kind of consider. One is an active market. This is very important to IFRS 13. This started actually creeping in back in the late 2000s, 2008, 2009, when we had our first, at least in the United States, we had our first real major recession in many, many years. And people were having trouble with the valuations because they weren't getting good information. So they went through and they said, okay, we need to clarify what we mean. And so they came up with different markets. So an active market is where an asset or liability transacts regularly and sufficiently to give you information. What does accurately and sufficiently mean? That varies by industry, but it's something that you as an appraiser have to look at. An exchange market is in which closing prices are both steady and available. An example of this is the New York Stock Exchange. So equipment can trade in an active market. Equipment typically does not trade in an exchange market. An exchange market is typically for stocks and bonds and things of that nature. A brokered market is where a broker attempts to match buyers and sellers, but does not put their own money in. In other words, a broker says, I've got a machine over here that is owned by this company. I will sell it to you. And what I'm going to do is I'm going to take a part of that price as my commission. A dealer market is where the dealer will buy it from company A, put it in the stock, and then sell it to company B. So most of what we do in machinery and equipment takes place either in a brokered market or a dealer market. It goes from end user to end user, either through a broker or through a dealer. So this is the market that we play in for the most part. A principal-to-principal market is where there's no broker involved, there's no dealer involved, and basically, me as a company sells it to another company directly. Now, those are typically the hardest prices and hardest results to find because of the fact that it's just difficult to gather that data. IFRS also goes into two different prices called the entry price and the exit price. The entry price is the price to acquire an asset, and the exit price is the price to sell that asset. Now, there's minor differences here, but fair value is an exit price, not an entry price. Now, from our standpoint, I'll be honest with you, it doesn't matter that much because we're probably, and I'm hoping that you're going to the market where you can to find data. In other words, if you can find an asking price for a piece of equipment, you're using that data. So in reality, for us, the entrance and exit price are very similar. Where this is really an issue is when you get into like stocks and bonds and things that have a spread. That is where people that are valuing those assets really have to consider exit versus entry price. Another term to know is transaction prices, transaction costs. Transaction costs don't mean a lot to us because this is kind of what is costing the company to buy the company. They got brokerage fees, they're paying somebody. They got appraisal fees, they're paying us. They have audit fees. They got all these different fees. They basically, all we need to know is that those get expensed and those are not part of the purchase price. So that's all that really you need to know about that. Highest and best use. So we've got to consider the highest and best use. So we got to look at what is the highest and best use of our asset to anybody. What is the market participant? What is the market telling us is the highest and best use of this asset? Not what our buyer is telling us is the highest and best use. but what would the general public or the general market participants, how would they use this? And we'll go into that in a little bit later on how that can vary. When you're looking at inputs, inputs are what we are using to value our asset. So we're looking at two different things. We're looking at the risk of that particular evaluation technique, and we're looking at the inherent risks of the inputs to that technique. So the risk is the uncertainty or chances of error. So one thing we've got to consider when we're doing the valuation is we want to use inputs that minimize the risk so that our measurement is reliable. And again, this has more to do with companies that are valuing the intangible assets or assets that have a bid spread or something to that effect. In our particular world, really where this takes care and where this takes precedence is if you are just simply taking a fixed asset record and running a cost model, I would say that your valuation technique has got relatively high risk factors, unless you're going back to the marketplace and somehow judging and making adjustments to your model. That would be a high risk to me, because you're not really focusing on what's going on in the marketplace. So there are ways that you can minimize that risk by doing some market checks and making sure your obsolescences are proper and those types of things. Now we're going to dive deep into the crux of what it is. And remember, I told you that we're going to spend quite a bit of time on this one definition. And we're going to spend a lot of time on it because some of the words need to be redefined. So you take a definition, and then you got to define words within that definition. So in the next few minutes, maybe next 10 or 15 minutes, we're going to tear apart this definition. So the definition of fair value is the price that would be received to sell an asset. We'll define what an asset is. Excuse me. Or paid to transfer a liability. So again, you buy an asset, you obtain a negative liability in an orderly transaction, and they specifically say not a forced liquidation or distress sale. So an orderly transaction is not a forced sale between market participants as of the measurement date under current market conditions. What are current market conditions? Is that when you're doing the appraisal? No, the current market conditions are as of the measurement date, which is the same as the acquisition date. So again, you got to make sure you're going back and putting your mind back into what was happening at the date of that transaction. So now let's dig into some of the different areas and what do some of these things mean. So an asset or liability, when you're looking at an asset or liability, you need to look at these three things. You need to look at the asset, the condition, and location of the asset or liability. We're not really looking at liabilities. We're looking at assets. So we have to look at the condition and location of the assets. That's pretty basic. I mean, this is part of the reason I like to do inspections and not just do desktops, because I want to see what is the condition of that asset. That's very important. You want to know if there's any liabilities or restrictions to the sale of that asset or the transfer of that asset. So are there any liens, any leases? Is there something that is, well, and again, I don't know if you use this term. We use the term grandfathered, which means that as long as you own it, you can do whatever you want with it. But the moment you sell it, the buyer is under a whole different set of rules, and they might not actually be able to use that asset. And that can happen if you've got a piece of equipment that is not maybe environmentally friendly, or sometimes you've got a piece of software that cannot transfer to another division. There's a lot of things that you need to look at and say, for example, it used to be this way with Da Vinci robots in the medical world, where I could use it, but I couldn't sell the asset to another company because they don't have the license to use it. And if Da Vinci found out that I sold it, they would literally shut it down, and they could shut it down remotely. So there was a restriction on the transfer of the Da Vinci robot. And so when I valued a Da Vinci robot, I usually put in an assumption that, you know, the buyer and seller are going to do whatever's appropriate to transfer that license over to the buyer. So is there a restriction that you need to consider? Whether the liability is standalone or if it's part of a group. So in other words, is this asset something I could sell by itself? Or do I have to put other things with it to be able to make it sellable? Now, again, for us, this is not a big deal. Usually, each piece of equipment is sellable of itself. There are times when it doesn't. Maybe, for example, on a paper mill or something of that nature, or maybe an oil transfer station where you could sell the tanks, but it's worth more if you sell it with the other tanks and the piping and all of that. So these are just things you need to consider. What do they mean by orderly transaction and price? And I apologize, the term ASC 820 fell in here instead of IFRS 13. But it clarifies, they're exactly the same clarification. An orderly transaction assumes exposure to the marketplace for a period prior to the measurement date. So it says, it's sold on this date, but it was exposed to the marketplace for sale and allowed market activities that are usual and customary. So what this is saying is that an orderly transaction is in an active market. It looks at what's going on within that market. It is sold in a way that is customary for that market. There are times when that does not happen, and we'll go over some of those. So the transaction is to sell an asset or transfer liability is a hypothetical transaction as of the measurement date. Now, you're probably looking at that going, wait a minute, my asset actually sold on that date. Why are you calling it hypothetical? Well, you're calling it hypothetical because your client and the company they bought from agreed to a purchase price. That is a true price. They agreed to that. But were there circumstances where that may not be 100% true? Under most circumstances, if it's sold properly and customarily, the answer is those should match. But there are times when the market participants would do something different. And that's why they're saying that you've got to look at it from a hypothetical transaction standpoint. We'll go into that a little bit later as well. You've got to look at something called the most advantageous marketplace. There are two marketplaces to look at. One is the principal marketplace, and one is the most advantageous marketplace. The principal marketplace is the market with the greatest volume and level of activity. So in other words, this is where the asset trades the most. That's the principal marketplace. Whereas the most advantageous marketplace is the market that maximizes the amount that would be received to sell an asset. So it's the marketplace that'll get you the highest dollar amount, the highest recovery. So keep in mind that the principal marketplace is where most of the activity occurs. The most advantageous marketplace is the place where you can get the highest amount of recovery. Now, fair value says that they look at the transaction in the principal marketplace. So in other words, you've got to look at where does this sell most likely and how does this sell more often than what's going to get you the highest amount. Now, again, this is really geared towards stocks, bonds, that type of thing. But from our standpoint, what is the principal marketplace? Well, usually, we talked about it earlier, it's usually a brokered marketplace or a dealer marketplace, and sometimes a principal-to-principal marketplace. For the most part, that's where our assets sell. They do sell at auction. That's another principal marketplace. But you've got to be careful to look at that and make sure you're coming up with a proper value. So you've got to look at the principal marketplace, but in the absence, you look at the most advantageous marketplace. So let's give you an example of something here, just to kind of give you an idea what happens. So let's say we have an asset that would sell for $1,000 US in the principal marketplace. But in the most advantageous marketplace, you could get $2,000 for it. So which would you consider? Well, I haven't really given you enough information yet. When you consider the most advantageous marketplace, you've got to consider the costs associated with that. So let's say that in the principal marketplace, you could get $1,000 for this asset. It costs you $200 to move. But to go to the most advantageous marketplace, you could get $2,000, but it'll cost you $1,200 to get it there. So the net is only $800. So in that area, you would conclude in the principal marketplace, because it doesn't make sense, the buyer would not go to the most advantageous marketplace because it costs them too much to get there. So there are some intricacies and things you got to consider when you're looking at valuations for financial reporting that you may or may not have to consider in other valuations. But it's really not as hard as it sounds, just to be honest with you. The reporting entity, and meaning you, because you're basically giving your data to the reporting entity and they're using it in their financial statements, you don't have to do an exhaustive search of the principal marketplace and most advantageous marketplaces. But what you've got to really consider is, how would I normally get rid of these assets if I were to sell them? Now, again, we're looking at two different things. We're looking at the sale of an asset or the sale of a company. Now, usually when you're looking at a purchase price allocation or financial reporting, you're looking at the sale of a company. So what you've got to decide is, does it make sense to say, I'm selling this as an entity in continued use? Or would it make more sense to say, I'm going to sell all the assets individually on an in-exchange premise? And we'll talk about a little bit how to kind of make that decision in a few slides, but that's really the decision you have to make as the appraiser. But I wouldn't make that in a vacuum. I would talk to the client, I would talk to the auditor, I would talk to the person doing the business valuation and say, I'm going this direction because, and we'll tell you some becauses later, some reasons to do it. So the other term that needs to be discussed in the fair value is a market participant. So who is a market participant? So a market participant is independent. They're not related to the entity. They're knowledgeable. They have the reasonable level of understanding of the business and the asset. They are able to transact. In other words, they either have the money or the cash, or they're able to get the money, and they're willing to enter that transaction. So if you look at these definitions, who does that sound like from your past world as a valuation person? This is a willing buyer in the fair market value definition of willing buyer and willing seller, right? So the market participant is just your willing buyer. That's all it is. They're nobody special. But the one thing that the market participant gives into this that your willing buyer does not is you have to consider, what are they willing to do and how would they see this asset? And again, I'll give you a little, in the next slide, I'll give you a little example here. So the valuer needs to consider, what would a market participant do? What would the typical buyer do, not your buyer? And let me give you an example. I did a evaluation of a large conglomerate. They do chocolates, they do food, they do coffee, they do a bunch of things. Happen to be based out of Switzerland. And they purchased a company primarily to shut down a competitor of theirs. So they bought this company that did a couple products, and one of the products was an instant coffee. Well, this company had an instant coffee, and they said, well, you know, we don't like this competitor competing here, so we're going to buy this plant. We're going to use some of the assets, but we're going to shut the plant down. So this conglomerate was big enough that they could afford to do that, and it made sense for them to do that. But I went back to them, and I went back to the company that I was selling, and I went back to the auditor, and I said, let's look at the typical market participants. I said, looking at what, if I was a buyer, I would continue to operate that because they would be making me money. So we all agreed that the typical market participant would keep that plant running. So even though it was going to cost my client a write-off later, I had to value it as if it was going to continue to operate. They weren't going to shut it down for a couple of years. They were going to integrate a few things. So it was a couple of years that they were going to shut it down. But I needed to value it because the typical market participant would value it as a going concern. I valued it that way. Now, did I just value that way without discussing it with them? Absolutely not. I wanted to make sure that everybody knew what I was doing and why. So that was some of the whys. The next thing that was a definition and fair value is a measurement date. We've really kind of hit this one very hard, so I'm not going to go over it in great detail, but everybody understands the measurement date is your valuation date. fair value assumes that the acquired asset will be used as highest and best use. So again, you've got to look at what is the highest and best use, what is legally possible, what is physically possible, legally permissible, and financially feasible. Now, financially feasible is the one that normally messes people up. Does it mean that it's making a profit? No. What financially feasible means is that it has the capability of making a profit. There are many times when one company buys another company that's not profitable and it makes them profitable. So it's the mismanagement of the company that is losing them money. So it's got to be financially feasible. It's got to be able to make money in the future. So from our standpoint, what does this mean? Well, typically, if you're using a piece of equipment the way it's meant to be used, it's physically possible. It's most likely legally permissible, unless you're doing something illegal with it, which doubt you were if you're trying to sell a business. And you're using it because you want to make money. So really what this comes down to is the level of trade. Are we going to sell it installed or in use? Or are we going to consider it as maybe some sort of an exchange, which is what we're going to determine now. So I've been using these terms a few times, so it might be good to talk about what do we mean. So in exchange means that the highest and best use would maximize the value to a market participant on a standalone basis, sold as it is. An in-use basis would provide the maximum value to a market participant. And again, remember, market participant is the general market buyer, not your specific buyer. But it would be the value through combination with other assets in the group. Now, don't get this too confused with some of you who have taken some of the ASA courses. They have fair market value in use and fair market value in exchange. And the main difference is whether you include installation and other direct and indirect costs. That is not what they mean here, although it could be that if you're talking about an individual piece of equipment. But in this case, in exchange could be, I've got 3 plants and it's most valuable if I sell all 3 plants as an entity. That would be in use. But let's say that 2 plants do one product and the 3rd plant does another product, and it would be more valuable to take these 2 plants and sell them as one entity and take this plant and sell it as its own entity. That would be an in exchange from a reporting standpoint or value of a company standpoint. So in use and exchange could be an asset, or it could be total companies or plants. So just keep that in mind. So we talked a little bit about this. The highest and best use is either in combination with other assets. We talked about that. So in other words, the real decision maker when it comes to in use versus in exchange comes down to which is going to give us the highest amount of money. So which way would we get the highest recovery? So if a company is making money, most likely you're going to do everything in use. If a company is maybe not making so much money, or maybe they need to separate some assets, then you're probably going to go in an exchange premise. And we kind of talked about this. And again, this is going to be in your student manual, so I'm not going to go into this in great detail, but it's a little longer version of exactly what I was just kind of going through. So let's give you an example, a pretty easy example of somebody, you're in a plant and they got 3 production lines. One of the lines is idle and it's not being used. And the next company, the next market participant, they're not going to use it either. How would IFRS look at this? So under the in exchange premise, what types of costs might you consider? So if I was running across a situation and I realized the market participant probably would not operate that 3rd line, I would value the 2 operating lines in use, and I probably would value the 3rd operating line in exchange. But some of the things you have to consider is what would you do to that 3rd line in order to make it sellable? You might have to uninstall it. You might have to move it. You might have to figure some things. So you have to figure out the cost of deinstallation, the cost of selling that asset. So you'd have to consider those costs. Now we're going to jump to kind of another subject. And we talked about this a little earlier. transaction price as it relates to fair value, or how does a transaction, what was paid for it, how does that relate to the total value of the company itself? So in most cases, and this really does take case in most deals, the transaction price is equal to the fair value of all the assets and the liabilities. So for the most part, when company A buys company B, they're paying a fair price. They're paying fair value. So they are getting all the benefits. And there might actually be a little bit of goodwill built into that. So that's something you got to consider. But that's not always the case. And again, we're looking at it from an exit standpoint. When determining if the fair value of that transaction price equals a transaction price, there are certain things that you need to take into consideration. And I'm going to go over now some things that you need to consider that may point to you that this is not a fair value, or it's not the same. Transaction price is not equal to fair value. One of it could be when the transaction occurs between related parties. So if you've got two friends or you've got two businesses that are related, the transaction price between the two might be inflated or deflated. So again, that's really not an arm's length transaction, right? If they're related, it's not an arm's length transaction, which could point to not being a fair value. If the sale was under duress, if there's a bankruptcy sale, or if the company's losing money and they just want to get out of it. I had a situation recently where I had a brewery in the northeastern part of the United States that bought another brewery. The owners of the breweries happened to be friends, and essentially they didn't tell me this, but I kind of figured it out. I think the two of them sat down on dinner one night, and the first guy buying them said, "Okay, you want to retire? How much do you need to retire?" And I think this guy set a price, and this guy said, "Okay." Now they got a deal. They really bought a lot more in value than what this person selling wanted. But this person selling said, "I can get out of the business and I can retire for this amount of money." So I think that's what happened. So under that case, the transaction price was below fair value. And we proved it a lot of different ways. So there are times that happens. There are also times that somebody says, "I'm going to give you such the deal because you're a friend of mine and I'm going to pay more than fair value." Why people do that, I don't know. Another area that you might want to look at is where the unit of accounting represented by the transaction price is not the same as the accounting measure of fair value. So for example, let's say one portion of the assets is transferred with certain rights and the other one is not. So in other words, this one's kind of a little difficult to really kind of describe, but if, for example, you're selling something that you cannot really use because of the grandfather clause, then you might be paying for something that is not, the same value. The next one's something that one probably won't occur to us as much as this next one, where the market in which a transaction occurs is different from the market in which the reporting entity would typically sell the asset. So this would be a case where, it's not an arm's length transaction, or maybe it's a bankruptcy sale and the court says you've got to sell these assets and you've got to complete this transaction in 90 days or 120 days. So if that's the case, then it would not be that. That would be a different market in which it's typically sold. I had a situation where I was reviewing a piece of appraisal work from another company, and we went round and round, and it turns out that the client did not market the business properly. They only marketed it to one person. They said, "Hey, I want you to buy my business, and here's what I'm willing to sell it for." And the person had no idea what they were really selling, and they really they should have gotten a lot more money for it than they did. So they didn't market it properly. They didn't market to the people. So therefore, there was an issue, and the transaction price was nowhere near what fair value should have been. So those are just some things you need to consider when you're looking at, is the transaction price the same as fair value? And we'll talk about some situations later where, how do you handle it when it's not? If there's excess, it's real easy. It's called goodwill. If there's less, then there's a problem. We mentioned this a little bit later, that essentially fair value is an exit price. I'm not going to spend a lot of time on this because for us, it doesn't really matter that much. Again, it has more to do with somebody who's looking at something that's got like a bid and an ask price, like a stock or something of that nature. IFRS then goes on, and again, we're kind of reading through IFRS 13 as we go through this. So this is kind of the order it goes into. So it goes into 3 approaches, and the 3 approaches to value are the market or sales comparison approach, the income approach, and the cost approach, which is the same thing we consider, right? We look at those 3 approaches. And it says that you need to use the approach that is appropriate in the circumstances and for which sufficient data is available. So in other words, what they're saying is use the technique where you've got the best data and you're going to produce the most credible or believable results. So this is very similar to what we do, right? The International Valuation Standards and USPAP, they all say, look at the 3 techniques, use the one that makes the most sense, and go with that. In some cases, you might be able to use more than one, but take a look at it. It's saying that if you ever do a revaluation of the same company, that you need to use the same technique that you used the first time. Why are you doing that? Because you need to be able to compare the results of the 2. So in other words, if you used a cost approach primarily the first time, you're going to want to use a cost approach the second time to be able to compare the results. But you might change your valuation technique or your application if other data comes out that says that another approach may be more realistic or more valuable. For example, you might switch from a cost approach to a market approach if more market data becomes available for those pieces of equipment. So this might be the case if new markets develop or new information becomes available or information that you previously used is not available. Maybe a valuation technique approves or market conditions approve. IFRS then says, okay, you're going to use the approach that makes the most sense. But now we're going to break it down even further. And again, I think they're doing this just because they're accountants and they like to make it very difficult. But there are 2 types of inputs. There's observable inputs and non-observable inputs. So observable inputs use market data, such as publicly available information about actual events. And unobservable are inputs for which market data is not readily available and is developed using the best information available about the assumptions that market participants would use. So I will go a little bit into what does that mean for us in the next slide or 2. So where are you going to gather this information? You're going to gather it from these 4 markets, which we talked about earlier: the exchange market, the dealer market, the brokered market, and the in-principle to principal markets. So for us, what are observable inputs? For us, observable inputs might be things like replacement cost new data. You went to a market, you went to a dealer, and you said, what is the cost new of this piece of equipment? That's an observable input. You can point to a source. Used asking prices. You go on the internet, you go to a price digest, you go to like a price database, you come up with a used asking price or a used sales price. That's an observable input. You can point to it and say, that's an observable input. Here's where I got my data. Obsolescence factors based on market-derived data. Again, something you can prove mathematically. Other data from sources independent of the entity being appraised. This is a key. Observable inputs come from the outside of your client and outside of the company being purchased. Unobservable inputs are things like replacement cost data that cannot be verified, or if you trend historical cost, that would be an unobservable input because you can't prove it. You can prove the original data, you can prove your trend, but you can't necessarily prove that the number that you come up with is appropriate. Estimated fair values received from representatives of the entity being appraised, or in other cases is replacement costs being provided by the entity being appraised. I've got a situation coming up like this very similarly where I've got a client that even though they're in an industry that a lot of people play in, a lot of people operate in, their equipment is very specialized. So I'm going to have to rely on their engineers to give me a replacement cost. Even though I trust the engineers, even though I believe they're going to give me good data, it's still unobservable because it's coming from inside the entity. And when you're doing an audit or you're doing evaluation and it's going to get audited like these will, you want to maximize observable inputs and you want to minimize unobservable inputs. So pretty much remember that observable is something you can point to. Unobservable is something that might have there's a little more assumption based into it. And we already talked about this, that essentially you want to maximize observable inputs and minimize unobservable inputs. We've got about 5 minutes before a break. I'm hoping I can get through the next subject matter before we hit that. They go from observable and unobservable to what we call a fair value hierarchy. So it gives more reliability to a quoted or level 1 price and less liability or less reliability as the levels go down. So we're going to go over each one of those real briefly. A level 1 is inputs reflecting quoted prices for identical assets or a liability in an active marketplace. What does that mean for us as a machinery and equipment appraiser? That could be an exact match comparable. In other words, you find, I've got this piece of equipment, I find an exact match, the exact same age and everything, or I go to a dealer and I say, what's the replacement cost of that? That's a level 1 input. It's the exact same machine. Level 2 inputs are prices that you find in the marketplace, but you need to adjust them somehow to come up with a value. So again, this level of hierarchy is really set up for intangible assets and things like stocks and bonds, but it could reflect for us. So for a machinery and equipment valuer, a level 2 input would be an adjustment made to a market comp. In other words, you say, this thing's very similar to mine, but I need to adjust it. So therefore, you need to make some adjustments. However, if the adjustments are so large, then it might become a level 3 input. Level 3 inputs are things that are not directly observable in the marketplace. So again, I've mentioned over and over again that fair value is a market-placed value. It's based on market participants, market data. So for a machinery and equipment valuer, a level 3 input would be a trend and depreciation exercise with only giving us the client data and assumptions without making any market-based adjustments or any further analysis. So this may or may not produce reliable results. So just be careful when you're doing a trend and depreciation exercise, that when you do it, you make sure that you use as many observable inputs as you can and limit the unobservable inputs. I think this is a great place to take a little 10-minute break. Ruka, did we have any questions before we do that?
Yes, I've got 2 questions. The first one is, what is retrospective appraisal?
Okay, excellent question. So when you do evaluation, if I was doing it today, which is here, it's August 29th. There, I think it's August 30th. Am I right, Mustafa? It's August 30th. You're one day ahead of me, right?
No, still 29.
Okay, still 20. I'm sorry. Okay, still 20, just hours ahead. So that would be a current valuation date. Retrospective means you're doing evaluation in the past. You're doing evaluation that is sometime before the date that you are today. So when you're doing that, you've got to be very careful that you only use information from that time. And USPAP even goes further, and I think IVS says the same thing, that you cannot use knowledge from that date forward to influence your values going backward. You need to really put yourself into that past date. So that's retrospective. Prospective is putting a value into the future. And I hate those because you make a lot of assumptions that you have no idea if they're even going to come true. So there's current, retrospective is past, prospective is future.
Okay, right. Another question. When calculating depreciation of physical assets, it is clear how you do. For example, useful life, etc. However, how do you account for other costs related to the plant, such as engineering, equipment, transportation, and customs clearance?
Okay, that's another excellent question. So I think if I understand the question properly, they're saying it's very easy to depreciate the value of the asset itself, but
Yes.
how do you depreciate all the direct and indirect costs that are not the asset itself?
Yeah.
That is actually a very interesting discussion that actually a lot of us are having right at this point in time. A good rule of thumb, something we do, and again, this is not official. This is, I'm talking here. I'm not talking from Taqiim. I'm not talking from the ASA. I'm just saying, what does Doug Kreiser do? For the most part, I depreciate those pieces of value the same as I depreciate the asset. And my theory behind that is those costs are directly tied to that asset. Once that asset disappears, those costs also disappear. Now, you may have a tank and you may have a foundation, and the foundation will stay there once the tank disappears. But then when you put a new tank on that foundation again, you're probably going to have to do something to that foundation to bring it up to you're going to increase the life of that foundation again. So again, what I do is I depreciate it based on the asset. Once the asset disappears and something else takes its place, then you start that process all over again. So I would depreciate all those direct and indirect costs at the same rate as the asset itself. And again, that's just me. And a lot of appraisers take that position. Other appraisers take a different position, but I think you're safe doing that.
Okay, that's fine. Another one, I think it's reinforcing the previous question. How do you get the comparables for a retrospective valuation? Or what's the best way to estimate the value?
Okay, that's an excellent question. It's difficult. Sometimes when you're doing a retrospective appraisal, it's good to start with a cost approach because you've got the data to do that. Now, what I do, I'm in the middle of a retrospective appraisal right now. I've got a valuation. This is not for financial reporting. This happens to be for an insurance claim, but the loss was 2 years ago. So what I'm doing is I'm going back and I'm talking to dealers that are in the industries, and I'm saying, I know what the prices are today. Can you tell me what the prices would be different 2 years ago? So that's one way, is talking to dealers. Another way is some databases and some, like for example, I'm not sure how many of you are familiar with a website called Machinery Trader. They do mostly construction equipment. They will keep auction sales and some asking prices back 6 or 8 months. And if you contact them, you can even go back a little bit further. So they could actually give you data that's older. Now, again, that's just construction equipment. That's not machinery. There's a service out there called DataRef, which tracks auction sales. They've got 20 years of history. So I know that's auction sales. That's not market value. But what you can do is you can go back and you can say, here's my asset today. It's selling for an average auction price of this. Here's what my asset was selling for, 2 or 3 years ago, or it won't be 2 years ago, it'll be a year ago, because you're going to stay within that 12-month window. So you might be able to take your stuff from today and adjust it based on a relationship from looking at that data. Retrospective appraisals are not easy, and they take a lot more work. And sometimes people don't understand you've got to charge more because it takes a lot of research. So it's a lot of research.
Yeah, that's correct. Sometimes you have to buy subscribed data.
Oh, yes, you have to buy
Yes,
data.
yeah.
Yes.
Mhm. Okay, another question. What debt would be on your retrospective valuation?
I'm sorry, what was the question again?
What debt would be on your retrospective valuation? Maybe
What
the
dates?
valuation debt.
The valuation date would be the date of the transaction. Whatever that date of the transaction is, that's the valuation. That's my date of value.
Okay, that's fine. Right, another question. what are the most common mistakes happen during appraisal for financial reporting?
I will get to that at the end of the presentation. You will get a good list of mistakes.
Okay, thank you. Then another one, Mr. Douglas, thank you for this valuable information. I would like to enter with you. Not sure.
Like right. What?
maybe you said I would like to enter with you. Maybe
send me an email. We'll talk about it offline.
Okay, that's fine. My question, our topic is the valuation of machinery equipment for the purpose of financial reports. And the type of value is fair value. If all the information about the machines is available to me as a resident, maybe as a resident valuer, how do you determine the percentage of physical, functional, and economic depreciation? And what is the method followed?
That is a webinar in of itself. That's beyond what we're going to go into here. How to actually calculate physical, functional, and economic is probably another 3-hour webinar.
Yeah.
So we can get by the latest Valuing Machinery and Equipment published by the American Society of Appraisers. There's a whole chapter on that.
Oh yes, the textbook.
Yes, and also take the Taqiim courses. There's some good data in there as well.
Yes, yeah, we have some chapters on that as well.
Yep.
Okay.
Sorry that I can't answer that. I would be here for another 3 hours.
Yeah. Okay, that's fine. I think you got the idea. And then what's useful life to use for DRC calculations? Physical life, economic life, useful life, entity specific. Please talk to us a bit about lives, published lives, etc.
So they're asking, what life do you use?
Yeah, maybe some sources of the useful lives, maybe published or something.
There. Okay, so I guess the question is, are you asking what are there any published sources, or which life do you use? Because there's two.
Yeah, which life? Because the first question is saying what useful life to use for DRC.
That hopefully I can answer this. For those of you who know me, I'm sure there's some people on here that know me, and I like to give long answers. I will try to give a short answer. Normally, the life that I use is physical, normal, useful life. Now, the exception to that is, let's say you have a process that you know is going to end in 5 years. Let's say you've got you're making a product that you know has a certain life. Even if the physical life of the asset is 10 years and that production line is going to end in 5 years, and if you can say there's lots of and ifs, and if that equipment is no longer going to be usable after that 5 years, then you shorten it to the economic useful life of 5 years, because that's all it has left in it. Now, if that equipment can continue to be used and you've determined that there's 10 years remaining of physical and that equipment can still be used, then you go back to the 10-year physical. But it all depends on what's going on with the product, what's going on with the company. If they're going to shut down in 5 years and those assets are not going to be used beyond that, then that's the life that you use. So it really depends. And I think what people are realizing, I'm hoping you're realizing, is that this takes a little bit of research and a little bit of testing and a little bit of due diligence. So.
Okay, that's fine. Another one is, what do you do if at the measurement date, the remaining useful life from chronological calculation becomes 0 or negative?
Okay.
In other words, when a machinery has surpassed its useful life or economic life.
Another excellent question. What I do is I develop, and again, how you develop it is another at least hour webinar or more. You have to develop a minimum normal remaining useful life. So for every asset, I've got somewhere in my brain or my database a minimum that I will give it. Maybe it's 1 year, maybe it's 2 years, maybe it's 3 years. But as long as the piece of equipment is still being maintained and operated, it's still got at least 2 or 3 years remaining useful life. So you have to kind of get a floor or a residual life that you stick with no matter what happened. Now, if there's a rebuild, that can change, but you've got to come up with some sort of a floor that you never go below.
Okay, that's fine. Then there's another question. Is it possible for a 5-year-old asset to appreciate in fair value because of exchange rates, taking into consideration that no upgrades have been done on the assets?
So this person did a mathematical calculation on their thing, and all of a sudden their value is higher than what they paid for it 5 years ago.
Yeah, maybe because of exchange rates. You know, like us in Saudi Arabia,
yes.
We are machinery consumers. We don't construct machines.
Mm-hmm.
So when we import, we use the exchange rate.
Yep.
Lucky enough, our exchange rate does not fluctuate that much.
Right.
So in case we happen to have, maybe in some other countries where inflation is going up and down, so maybe you use the inflation, you are given a figure for replacement cost in Forex, and then you try to bring it to the local, and then it looks like it's higher than the previous.
All right. So the answer to that question is sometimes. So you got to be careful. You got to be careful, and the reason I'm saying that is you got to be careful that you're not, to make sure that you're using the right data. So if you're importing a piece of equipment from, let's just use Poland or China or India or some country that's got inflation that is going all over the place, it's going to be very difficult to use their inflation factors to come up with your number. It's better to try to actually contact the manufacturer and come up with a real replacement cost than to do a trend when you're dealing with a country with a very variable inflation rate. If you can't do that, then you're stuck with what you've got. And yes, I mean, we had a situation here in America where, and this had to do not with the exchange rate, but had to do with supply and demand, where trucks and trailers that were 3 and 4 years old were selling for more than a brand new one did 3 or 4 years ago, because the demand was so high, the supply was so low, and so that did happen. So can it happen? Yes. But if it happens, you need to really be able to sit down and explain to your client why. And if you just say, because I applied an inflation factor and then depreciated it, that's not a good explanation. You need to dig into that and say, well, inflation rates, the exchange rates are changing, inflation rates are changing, and we know that this is real. Other than just don't just do math. To me, a cost approach can be just math. You've got to be able to describe it and understand it. And the answer to your question is yes, it can happen, but you better be able to explain why. So shall we pick up where we left off? Hope everybody had a pretty decent break there. So now we're actually going to switch, and again, we're kind of following IFRS 3 through. The next subject that they go into is the market activity level. Come on, guys, move that over. So it's based on an active market. Okay, I don't know if we have our translator here. I don't see him on the. Oh, there he is. Okay. So we have an active market, which is defined as the market in which the transaction for the asset or liability occur with sufficient frequency and volume to provide pricing information on an ongoing basis. So in other words, what they're saying is that the value of fair value is based upon an active market. So it may be affected if there's a significant decrease in the volume or level of activity in relation to the normal market level. So in other words, an active market or the fair value could decrease if the market is an inactive market. So what do you do if you're not in an active market? Well, first of all, you've got to determine whether or not, are we in an active market now or are we not? So that's one of the first things you have to determine. So how do you determine that? So first of all, you've got to look at what's going on in the marketplace. Are there fewer transactions than what normally occur? Are the quotations not based on current information, which is kind of an awkward way of saying, are there any current selling prices or are there current asking prices that we can look at? Or are we looking at data that might be a year old or 6 months old or something of that nature? Pricing or quotations vary substantially over time among market makers. In other words, there's a lot of volatility in the pricing. During COVID, for example, in the United States, I know that some people were asking huge amounts of money for pieces of equipment because they said, there's not that many out there, so I'm going to ask a lot of money. Well, sometimes that was real, sometimes it wasn't. So are they increasing the prices over time? Indexes that were highly correlated are not correlated now at this point in time. So these are just some things that you have to look at and say, if some of these things are true, then we might not be in an active marketplace. So you've got to take a look at what happens when you're in an inactive marketplace. And again, this has more to do with financial instruments, but it'll say there might be an increase in the implied liquidity risk premiums. Well, we don't deal in implied liquidity risk premiums, but the financial world does. But what you might want to do is maybe if you're looking at a particular sector and you're doing valuations in a particular sector, you can maybe look at what's going on in that sector. And if the liquidity risk premiums are increasing, then it might not be an active market. So another reason that you might want to look at it, again, financial instruments. There's a wide bid and ask spread. So in other words, the bid and ask pricing is extremely wide. There's a significant decline or absence of market for new issuances of an asset or liability. In other words, if you're in the equipment market and there's not a lot of equipment coming on the marketplace, then you're maybe not in an active market. Little information is released publicly. In other words, there's lots of principal to principal value or sales going on. Those might be some things that you might look at to say we might not be in a real active market. So in other words, all this is really saying is that you've got to look at all of these pieces of information. And if you decide that you are not in an active market, then you got to look at and say, well, the data that I'm gathering here may not really be a determination of fair value. Now, just because there are variances in the marketplace, does that mean that it is not a determination of fair value? No. But again, you as an appraisal or valuation professional, you need to look at the data and say, does this data represent what a typical market participant under typical market conditions would recover today? So even if there has been a significant decrease in the volume and level of activity, it is not appropriate to conclude that the transaction is not orderly. So in other words, we got to look at and say, just because there's less activity, is it still appropriate? And that's something you've got to take a look at. So circumstances that may indicate the transaction is not orderly is there was not exposure to the marketplace for a period before the measurement date. In other words, it might be some sort of a liquidation sale happening where the pricing is below what market transactions could be. There is usual and customary marketing period, but the seller marketed the asset to a single market participant. So again, this is kind of looking at the overall value of the company. Was it marketed properly? Was it marketed to a wide group of sellers, or was it marketed to just one individual? Or was the seller required to sell to meet some sort of regulation, or maybe they're under bankruptcy? So again, that would tell you that you're probably not in a really good active marketplace. Another thing to look at that may say that it was not orderly is it's an outlier when compared to other recent transactions. So again, this could be at a company level, or this could be at a asset level where all of a sudden you see, one or two items that sell for significantly higher or significantly lower than what's going on in the marketplace. That could tell you that that particular transaction was not orderly. So if a reporting entity, which is the company that's doing the reporting, determines that the transaction is not orderly, then they're going to give very little weight to the transaction. So you as the appraiser, this is when you look at your comps and say, well, you know what? I'm going to take that comp and I'm going to ignore it because it is not really indicative of what's going on in the marketplace. So then they go in the active marketplace and then they say, okay, what should they do give us some guidance, finally, something for us to look at and say, what do we need to look at? Well, these are some of the things we have to look at. We have to look at, remember, we talked about the most advantageous marketplace versus the principal marketplace. We got to look at what is that marketplace. We have to look at what would the typical market participants do. And again, do we need to go out and find 100 market participants? No, but we have to consider what are we doing when we're doing evaluation? We're acting as a market participant. We're saying, what would I do as a person in this situation, knowing what I know, having the money to spend the money, being able to buy this company and knowing what I know, how would I act? So that's what you got to kind of consider. You got to look at the highest and best use. Is it level of trade? Is it in use or in exchange? We talked a little bit about that. We have to look at the most appropriate valuation technique. What is it? Is it the cost approach? Is it the market approach? Is it an income approach? Again, remember looking at independent inputs versus dependent inputs, which is observable versus unobservable. We have to look at good data versus questionable data. Good is in quotation marks because what is good data? That sometimes varies with what you have. And you must review which transactions are orderly. And it discusses in detail how the acquirer should disclose the details of the combination. This is really, that is really an accounting standpoint that has nothing to do with us, but we're going to give them data that they're going to put in their financial statements. And again, keep that in mind when you are doing this. The numbers that you give them are going to end up on their financial statements. So you need to make sure you're doing them appropriately. But how they report that is really out of your hands. There are ways, and there's I don't know, hundreds of pages within IFRS 13 about how they have to report things, but you don't have to worry about it. In a nutshell, that's IFRS 13. Now we're going to move over to IAS 16, which is plant and equipment. And I'm going to give you just a couple of definitions here. We're not going to talk about a bearer plant very much. You might run into some of those. A bearer plant is basically something that produces agricultural produce. It's in there. That's a term that is not in the U.S. version. I don't know why. It probably should be, but most farms and such are bearer plants. The important one on this slide, there's two things that are important. First of all, is carrying value. We already talked about that. Carrying value is synonymous with net book value. So it's the value of the asset after deducting accumulated depreciation for accounting purposes. And then the cost is basically what's paid for an asset. And remember, cost does not necessarily equal value. So cost is what is paid, value is what something's worth, and sometimes they're the same and sometimes they're not. I'm not going to read entity-specific value. When you get your student manuals, you can look at that. Impairment loss. We're going to talk about this later, but impairment loss is very important. This is another reason why you do financial reporting, is for impairment purposes. It's the amount by which the carrying amount of an asset exceeds its recoverable amount. And again, we're going to kind of parse that definition out a little bit later on. But just keep in mind that impairment is where the value of the asset is not equal to, it is usually less than the carrying value. Property, plant, and equipment are tangible items that are held for use in the production or supply of goods or services and are expected to be used for more than 1 year. This is what we do. Finally, they gave us a definition of something that says, this is what you're doing. You're doing property, plant, and equipment. Hallelujah. We finally get something good in there. Recoverable amount is the key, is the higher of an asset's fair value, less the cost to dispose and its value in use. And again, we'll kind of go into that a little bit later. I'm not going to talk about residual value. Useful life. Question came up about useful life earlier. Useful life in IAS 16 is a little bit different than the way we consider it, but it's the period over which an asset is expected to be available for use, or the number of production or similar units expected to be obtained by the asset by the entity. So it can be a period of time. In other words, we think this asset's going to last 10 years, or it could be a measure of production. We think that this asset will last for 1 million pieces, and then we'll have to replace it. So useful life could be either a time frame, or it could be a unit of production time frame. It prescribes the accounting treatment. And again, we're not going to go over that first paragraph because the accounting treatment we really could care less about. That's not what we're here to do. That's the accounting part of it. But what you got to look at is the second paragraph. The principal issues in accounting for property, plant, and equipment are the recognition of the assets. In other words, the booking of the asset value, the determination of their carrying values, the depreciation charges, and the impairment losses to be recognized. So what we do as valuers is when there's an allocation of purchase price, we give them that recognition of value. We help them figure out their carrying value. We tell them if there's an impairment. So there's lots of things in there that we do. The standard does not apply to property, plant, and equipment that's held for sale, which is IFRS 5, which we will talk about. Does not account for biological assets. We're not going to worry about biological assets. That's a very specialized valuation that we're not going to consider. There's a couple other things like mineral rights and things that this does not apply to. And again, they're very specific about this because they want to say if you have this, you got to look elsewhere for other standards you have to look at. So IAS 16 goes on to say the cost of an item of property, plant, and equipment shall be recognized only if, number one, it is probable that future economic benefits will flow to the entity and the cost of the item can be measured reliably. In other words, you're only going to recognize, you're only going to capitalize, you're only going to put an asset on your fixed asset records if you're going to get some future benefit from it by making cash from it or making a product, and that the cost of the item can be measured reliably. So again, we're talking about property, plant, and equipment here. We are not talking about intangible assets. That's covered under a totally different IAS. The standard does not prescribe the unit of measure. It constitutes what a piece of property is. It does not, in other words, it does not tell you that you have to break a piece of equipment up into so many components. But it does say that judgment is required in applying the recognition criteria to an entity's specific circumstances. So we'll talk a little bit about that later, but there are times when you may take an asset and you may actually capitalize it into different pieces on the asset record. And we'll go into that, like, for example, a little bit later on. So the first thing they talk about is something called initial recognition. So that is just not me going to Ruka on the street and going, hey, I recognize you. That's not what this is. This is more initial recognition of the asset. How do you, that's a British term for how do you capitalize an asset initially. So the cost of an asset can be booked either at the purchase price, which includes import duties, purchase taxes, and other items. Any cost directly attributable to bringing the asset to the location, so any direct and indirect costs. So when you initially buy an asset, you have the asset itself, you have import duties, purchase taxes, direct and indirect costs, and the initial estimate of the cost of dismantling and removing the item and restoring the site to which it was located. That only really happens if you've got like a mining property and you need to recover that, or some sort of property that you have to bring back to nature's beauty at the end of it. That's usually a liability, and that's booked as a liability. So these are just some things that when you're looking at direct and indirect costs, these are some of the things that you're going to have to add. Employee benefits, site prep, delivery, installation, testing. Those are all direct and indirect fees that are going to be added. So when you're looking at a fixed asset record, or you're looking at a group of assets, you're going to want to make sure that you're incorporating these for initial recognition. Now, after that, so they buy an asset and then they start depreciating it. They have two ways to depreciate their asset. They can do a cost model or they can do a revaluation model. Now, in the US, we primarily do what's called the cost model. And basically what that means is that after recognition, the piece of property, plant, and equipment shall be carried at its cost, the cost that they paid for it, less accumulated depreciation and any accumulated impairment loss. That's basically straight accounting. The second way is the revaluation model, which you might hear it called mark to market. So what this does is that on a periodic basis, usually an annual basis, you need to revalue all of the assets. You need to physically revalue them at fair value. So instead of taking an asset and depreciating it over a period of time and taking, a 10-year asset and taking 1/10 of it off every year or every 2 years or every 3 years, you revalue that asset and you put it on your books at whatever the value of that asset is as of that date. Now, the revaluation model is a lot more accurate because you're actually valuing what is that asset worth today, but it's time consuming and it's costly because you've got to hire appraisers pretty much every time you do this. So, and the one thing you can't do is once you choose the cost of revaluation model, you can't change it. So once you choose it, you're pretty much stuck with it. So when an item of property, plant, and equipment is revalued, the carrying amount is adjusted to the revalued amount. Just keep that in mind. The asset is treated in one of the following ways. The gross carrying amount, or the net book value, is adjusted in a manner that is consistent with the revaluation of the carrying amount of the asset. So in other words, whenever you revalue the asset, you just put that new value back on your books. Or the accumulated depreciation is eliminated against the gross carrying value, or the amount of the adjusted of accumulated depreciation forms part of the increase or decrease in the carrying amount. Again, this is how they physically do what we're asking them to do. We give them the value. This is the accounting, how they handle it from an accounting perspective. One of the things that you got to consider, and this is something that's good for us as machinery and equipment valuation folks, is that if they decide to do this revaluation technique, if any item is revalued, the entire class has to also be revalued. So in other words, if they decide to do a valuation of just their machinery, they can't pick one line and say, I just want to do this one line. If they chose the revaluation method for all their machinery, they have to value all of their machinery again. That's kind of a good thing. So what are some of the classifications and groups? So here are some. You've got land and buildings, machinery, ships, aircraft, furniture and fixtures, office equipment. So once they typically choose one method for all of these. Then guess what? Every so often, you've got to do a valuation. So basically, this is just saying that if you do one type of revaluation, you've got to essentially do it to everything, and that you've got to kind of keep an update going forward. If an asset's carrying amount is increased, the increase shall be recognized in other comprehensive income and accumulated in equity under the heading of revaluation surplus. So again, this is an accounting standard, but what they're saying is that they have a certain category called revaluation surplus, which is the value that is greater than the carrying value. So if they've got assets that are valued greater than the carrying value, they put that value in this revaluation surplus. I don't know exactly what happens to that revaluation surplus because I'm not an accountant. Excuse me. If an asset's carrying amount is decreased, the decrease should be recognized in profit or in loss. So in other words, if the value of the asset decreases, they'll either increase the loss in the company or they'll increase the profit of their company depending on where it falls. Earlier I said IAS 16 does not tell you how to break up an asset or how to value an asset separately, but it does say that each part of an item of property, plant, and equipment with a cost that is significant in relation to the total cost of the item shall be depreciated separately. So, for example, if you've got an aircraft, you might have the engines, as most people know that do aircraft. I personally do not do aircraft, but the engines are a very valuable part, and they can be switched out many times in an aircraft. So you might capitalize the value of the engines as one thing, value of the aircraft as another. If you're in a tank farm, you may do the tanks, the piping, the pumps, the compressors, and so on. So how they break that up is kind of up to them as the accountant and their auditor. But you as the valuation professional, if they're breaking it up that way, you're probably gonna have to break it up that way as well. So how do you break it up? How do you decide what components are broken up? Well, what you need to do is look at your property, plant, and equipment and look at those useful lives. As useful lives differ, that's probably how you're going to want to break up those pieces of equipment. So again, it's not necessarily up to you to do it, it's up to them. But what you can do is you can use the same methodology and you can do whatever they need to have you do. So you might need to break up, all this is saying is you might have to depreciate major components of an asset separately. Or you could decide to put it all together as one major asset. Again, that's really up to the accountant and the appraiser, the accountant and the company, not so much up to you. So if you chose the first or the cost method, the depreciable amount of an asset should be allocated on a systematic basis over an assigned useful life. If you decide to use the revaluation method, then you need to look at it every so often and figure out how to depreciate it. So what are some things that you look at when you're trying to figure out how to classify an asset? Well, you look at expected usage, expected physical wear and tear. So those first two are what we call physical depreciation. You can look at technical or commercial obsolescence, which we call functional obsolescence. Or you can look at legal or similar asset limits on the asset, which we will call economic obsolescence. So IAS 16 then goes on to what they call an impairment, which is what we're going to discuss next. But it basically says that you capitalize your assets one way, but if they're impaired, then you've got to go to this next standard, which is IAS 36, which is what we're going to hit next. So see how they kind of relate to each other. Before we go too deep into IAS 16, there's a few terms you need to know. First of all, what is the cost of disposal? It's the incremental cost directly attributable to the disposal of an asset. So this is the cost of what it takes to get rid of it. Depreciation, that's accounting depreciation, not appraisal depreciation. Impairment loss. Impairment loss is the amount by which the carrying amount, and remember, the carrying amount is equal to what? The net book value. So the impairment loss is the amount by which the carrying amount of an asset or a cash generating unit exceeds its recoverable amount. So recoverable amount is what it's worth. The carrying amount is what they're putting on their books. So if what it's worth is less than what they're carrying it for, then you've got an impairment. So the recoverable amount is the higher, and this is the key, it's the higher of the fair value less the cost of disposal and its value in use. The whole idea of this IAS 16 is really summarized in the first paragraph. The object is to prescribe the procedure that an entity applies to ensure that its assets are carried at no more than their recoverable amounts. In other words, you cannot put an asset on your books for more than you could sell it for. That's really all this is saying. So if its carrying amount exceeds the amount to be recovered through the sale or loss of an asset, it's impaired. I'm sorry, no, if the carrying amount exceeds it, it's not impaired. If the value of the asset, hang on, let me back up. I apologize. I don't mean to confuse you, but I'm going to say this one more time. If the carrying amount exceeds the amount to be recovered, it's impaired. If the value that you can get for the asset is greater than the carrying amount, it is not impaired. Here's a bunch of stuff that does not apply to. I'm not going to go over this, but these are things that cannot become impaired. I shouldn't say that. There are certain things in here that can become impaired, but they're under different standards. We already discussed the first paragraph on here. An asset is impaired when its carrying value exceeds its recoverable amount. Last paragraph is kind of important. An entity shall assess at the end of each reporting period. And reporting period can be months, can be years. And so they have to assess whether there is an indication that an asset is impaired. If such an indication exists, the entity shall estimate the recoverable amount of the assets. So we're going to get into very shortly how a company or how a reporting unit assesses whether there's an impairment. The ability of an intangible asset, and again, intangible asset here, to generate sufficient future economic benefits is a carrying amount is usually subject to greater uncertainty before the asset is available for use than after it's available for use. What that is really saying is that if you've got an intangible asset, it's harder to value before you actually put it into play. So before you use a patent, you really don't know what it's going to be worth. After you put the patent in place, it's usually worth. It's easier to assess the value. So we're not going to go too much into intangible assets. We're going to focus primarily on tangible assets here. In assessing whether the indications that an asset may be impaired, they should consider the following. So again, we're going to get into how does a reporting entity decide, is this asset impaired or is it not? There are two different ways to look at it. There's external and there's internal. And we're going to look at the external cases first. So if you're looking at this, and again, you're not necessarily looking at this, the company is looking at this. So are there observable indications that an asset's value has declined? Can they see something in the marketplace that says my asset base has declined or the value of my company has declined? When they use asset, it's a very broad definition of asset. It could be the company, it could be the assets. Are there significant changes with adverse effects on the entity have taken place? Is there something that has affected me as an organization that would make the value of my company less? Are interest rates or other market rates of return increased to the point where they affect the discount rate in calculating an asset's value? I don't know what's going on in Saudi Arabia right now, but our interest rates are going through the roof right now. So a lot of companies who are very heavily leveraged and maybe have a lot of debt out there are probably looking at this, at least in the US, and going, I think we've got some problems. So I can tell you, I know there are impairment studies going on right now in the US. The fourth point, and again, these are external. These are influences from the outside, which we would consider economic obsolescence issues, right? The carrying amount of a net asset is more than its market capitalization. So we're saying that you can't sell this for what it's worth, what we say it's worth on the books. Those are external things to look at. Some of the internal things you look at are evidence of obsolescence or physical damage. Has an asset been damaged? Is there something obsolete about it internally? Have there been some significant changes inside the company that maybe affected equipment to become idle? Is there going to be some product that's going to be discontinued? Is there anything that's going to affect the useful life? And the question we asked earlier, somebody asked about useful life. This is where something might be impaired, or maybe you want to use a different useful life. If you look at it and say, we're going to discontinue this product, that may affect the value of the assets that make that product. Or the third one is evidence is available from internal reporting that economic performance of the asset will worsen or get worse than expected. So, they may say, well, we expect it to go down at a certain rate. Well, what happens if maybe that changes and it goes down at a rate higher than you anticipated? Here are some evidences. We talked about the internal and external. Here are some things that are very distinct that when you start seeing these, you're going to say, I think I got an impairment. So cash flows for acquiring an asset are significantly higher than budgeted. So in other words, if you're buying a brand new line and you think it's going to cost you $1 million, but because of problems with the line, it's not going to cost you $1.5 million or more, or 2 million or 3 million. That could be an indication that the value of that piece of equipment is less than what you think. Actual net cash flows or operating profit are significantly worse. Decline in budgeted net cash flows or operating profit. And operating losses or net cash flows of an asset are greater than you anticipated. So if you're starting to lose money producing a product, you think you're going to make money and you start losing money, that could be a major problem. it's not always necessary to determine both an asset's fair value less the cost of disposal and its value in use. If either one of those actually is greater than your carrying value, you don't have an impairment. But if one or both of those is below your carrying value, then you do have an impairment. And we're going to talk a little bit more about how to do that in just a little bit here. If there's no reason to believe that an asset's value in use materially exceeds its fair value less the cost of disposal, the asset's fair value less the cost of disposal may be used as its recoverable amount. This will often be used in the case where you have an asset held for disposal. So in other words, what they're saying here is that if you have an asset that's held for disposal and the fair value less the cost of disposal is greater than your carrying value, you don't have an impairment, but you still have an asset that's held for sale. And we'll talk about that under a different IAS that's coming up. You need to measure the impairment at a cash generating level. So what this is saying is that you don't measure impairment necessarily at the machinery level. You measure it at what's called a cash generating level or the reporting level unit. And then from there, you decide whether you need to push that down. So you don't look at, when you're initially doing an impairment test, you don't look at each individual asset. You look at the overall value of the company, which is usually done by who? That's usually done by a business enterprise valuation person that will look at the overall value of that reporting unit, and they will compare that overall value to the overall carrying value. And if it's greater, then they will say there's no impairment, even if certain assets might be impaired underneath it. But if it's less, then they will say, well, we've got an impairment. Then we need to figure out where is that impairment. Is it in the intangible assets? Is it in the tangible assets? Now, I say that, and then I'm going to back up a little bit and say, if you have a product line that is going to be discontinued, you're probably going to want to look at the value of all the assets in that product line, regardless of what the overall valuation is. But that's just under certain circumstances. I'm going to kind of skip this for now because I kind of want to, I need to move on to a couple different subjects. So IAS 36 requires an intangible asset with an indefinite useful life to be tested for its recoverable amount. So what is an intangible asset that has an indefinite useful life? Goodwill has an indefinite useful life. A lot of times a certain product rights or things, those have indefinite useful life. So you got to test those. And how do you test them? You test them on a cash flow basis or an income basis. So again, we're not doing this, but it's part of the whole valuation process. Costs of disposal, other than those having been recognized as liabilities, are deducted in measuring fair value less the cost of disposal. So what they're saying here is, if you're looking at an asset, unless you've already recognized it as a liability, and you're trying to figure out what the fair value of the asset is for impairment, you're going to take the fair value and you're going to deduct some of these other costs. Like, what are the costs of selling it? What are the costs of commissions? What are the costs of deinstallation? Those are all things that you're going to want to potentially deduct from the cost of your asset if it gets to the point of looking at your plant, property, and equipment. So how does this all start? I've already kind of indicated this, but the way you start this process is you do a discounted cash flow at the reporting level. So what is a reporting level? The reporting level is the area at the lowest level that you start reporting cash flows or report a profit. So at that point, you're going to do a cash flow. Now, there's a lot of specifics on how the cash flow has to be done that I'm not going to go into because they would just confuse you. And there's really no reason to go over that because that's not what we're here for. We're here for machinery and equipment. If and only if the recoverable amount of an asset is less than its carrying amount, then the asset shall be reduced to its recoverable amount. That is called, so the difference between the carrying amount and the recoverable amount, if it's less, is called an impairment loss. So the carrying amount also cannot be lower than zero. So that's a key. So let's say if you have an asset that you decide that it's impaired, and the asset's worth $25,000. If the cost of removal of that are $35,000, you can only write that down to zero. That extra $10,000 kind of disappears, or depending on how they do their accounting, they could book that $10,000 as a liability. But chances are they're just going to mark it down to zero. You cannot go below zero. So how is this allocation done? So you say, okay, we think we've got an impairment. What do we do? How do we do the math? And again, this is the accounting math. So the first thing you do is take the goodwill of the cash generating unit and decrease that. Secondly, you take any asset group, which includes the tangible assets, and then you decrease that. But if you get rid of all the impairment by getting rid of the goodwill, then normally it's assumed that the tangible assets are not impaired. The only impairment was to the goodwill. So you are not going to get involved as a machinery and equipment appraiser if the impairment is all handled at the goodwill level. Where you might get involved is if the impairment comes down to the tangible assets. So that's when you're going to get involved as a valuation professional from an MTS standpoint. In allocation of the impairment to an actual asset, meaning one of our assets, a tangible asset, it's the highest of its fair value less the cost of disposal, its value in use, or zero. Again, you cannot go below zero. So we're going to give kind of an example here, and I'm going to give two different assumptions, and we're going to decide, do we impair the asset or do we not impair the asset? So a machine has suffered physical damage, so it's been damaged in some way. It's still working, although it's not working as well as it was before. The machine's fair value less the cost of disposal is less than its carrying amount. So you took the machine, you deduct the cost of disposal, which means you take off the cost of installation and cost to sell and all that. It's below its carrying amount. This is the key. The machine does not generate independent cash flows. In other words, the machine is part of a process. The process is where they report cash generation. But this machine, you cannot say that this machine is so much value of that cash generation. The smallest identifiable group that includes the machine and generates cash flows is basically the production line in which the machine belongs. The recoverable amount of the production line that the production line is taken as a whole is not impaired. In other words, this machine is impaired, but the production line, if they take it as a whole, they're still producing enough cash on the cash flow analysis to be above the carrying value of all the assets combined. So we're going to do this under two assumptions. The first assumption is that we're going to keep operating this machine. Management has decided we're going to keep running. We're going to keep going. We're not going to do anything. We're just going to fix the machine. In that case, you're going to say there is no impairment here because the cash generation unit to which this machine belongs is still above the carrying value. I know that's confusing because your asset, that one machine, is impaired, but you've got to measure it at the cash operating level. As long as they continue to operate that machine, everything's fine. You're not going to impair one asset. Remember earlier I said, if you take an impairment and you measure it, you've got to measure it against the entire group. Well, this is an example where the entire group, the sum of the whole, outrides any impairment that's there. So the production line itself is not impaired. Therefore, you're not going to recognize any depreciation or any impairment. But what they might do accounting wise is they might shorten the life of that machine for accounting purposes. So now let's take that same scenario and let's change one factor here. So now they've decided, I want to sell that. I want to get rid of that machine because we need to do something here because that is a bad machine and we need to improve our production line. So therefore, they're going to decide to get rid of the machine. That one assumption of operating versus selling it changes whether you're going to impair that machine or not. Because now the machine is held for sale or disposal, which is something we're going to go over in the next set of documents. So therefore, you do impair that asset because it is now an asset held for sale. Hopefully that's not too confusing. So you've got to consider that. So again, there's a lot of research that goes into what are the intents of my client in doing these kinds of evaluations. This next slide is something that's very unique to international financial reporting standards that we in the US don't do. You get to reverse your impairment loss. So an impairment loss can be permanent and it can be temporary. The international financial reporting standards, if you go back later on and you decide that the impairment is gone, if the facts have changed and the impairment no longer exists, you can reverse that impairment. In the US, once we impair an asset, you can never reverse it. So that's one unique difference, which I think they're still working on. So what happens to that reversal? What can you do? So I'm actually getting a little bit ahead of myself. So what are some of the things you have to look at to decide whether there's a reversal of the impairment or not? So here are some things. Just like if you decide there's an impairment, there's external and internal purposes or reasons. There's also external and internal information to look at to decide whether you need to reverse that impairment. So the first one is observations indicate the value is increased. You're looking at the marketplace and you're saying, the value of my assets have gone up. The value of my company's gone up. Significant changes with favorable effect on the entity have taken place. In other words, we were having a problem, but things have gotten a lot better. So therefore, maybe we're worth more again. Market interest rates have decreased. The discount rate's getting better, things of that nature. So those are external factors. Internal factors could include things like, hey, there's been a favorable effect on the entity. Maybe the economic performance is getting better. Maybe we're making more money than we anticipated. We thought we were going to lose money this quarter. We're actually making money this quarter. There's some things that you can look at to say, okay, maybe we are going to reverse our impairment. So let's say you decide you're going to reverse your impairment. You're going to have a valuation done. Can you inflate your number just because you're doing better? Well, actually, you can't. So all you can do is you can only take your value up to the carrying amount that it would have been had no loss been recognized. You can't go any higher than that. So let's say if your carrying value of an asset was, 100,000 SAR, and then you decide that the value of your asset is now, 120,000 SAR. You can't increase it beyond that 100,000 unless you're using the revaluation method, which that adds a little bit of an intricacy to this, but you can't adjust it here. You have to adjust that at the next time you do your actual revaluation. So that does not happen here, that happens then. The whole point of this is you can reverse your impairment, but you can only do it to the point of where the carrying value would have been prior to that. Hopefully that makes some sense. Again, IAS 36 is hundreds of pages. I just did this in about 10 slides. It's not exciting reading. It's somewhat interesting if you want to get into it. But now we're going to get into a very interesting subject. I find this very interesting because I just did a valuation where this actually came into play. It's non-current assets held for sale and discontinued operations. So one of the things you got to look at here. So we're looking at a plant, or we're looking at certain equipment that are held for sale. So we'll talk about how do you value that. You might have an operation where they say, I've got 100 pieces of equipment. I'm going to sell these 20. So how do you value that, those 20? So we'll talk about this in a minute. We have to identify what this means, cost to sell. The cost to sell are advertising costs, commissions, premiums, transfer fees. So these are all costs to sell. You need to deduct these from the value of the asset to come up with your cost your value. The objective of this standard is to specify the accounting of assets that are held for sale and how they're presented in the disclosures. There's two things here. Is the asset held for sale, or is it going to be abandoned or discontinued? Assets that meet the criteria to be classified as held for sale are to be measured at the lower of. That's the key. So if you're trying to sell something, you have to value it at the lower of its carrying value, or the fair value less the cost to sell. That's really what that second paragraph means. And then assets that meet the criteria to be classified as held for sale are to be presented separately in the statement of financial positions. So in other words, what they're supposed to do from an accounting standpoint is say, I'm planning on selling these assets, and you have to separate those out so that everybody understands that out of the value of my equipment, this much of it is actually going to be potentially gone in a period of time. And we'll talk about what that period of time is in a minute. So an entity shall classify a non-current asset, and what we do in tangible assets is a non-current asset, if is held for sale, if the carrying amount will be recovered principally through a sales transaction than through continued use. In other words, how am I going to get value for these assets? Am I going to operate it, or am I going to sell it? Now, when your client comes up to you and says, "Yeah, I'm going to sell that equipment. Don't worry about it. I'm going to sell it." Can you take that as a yes? There are, in your case, there are 7 things we need to consider. The asset must be available for immediate sale. In other words, if somebody says, I want to buy it, your client better be able to give it to them within a reasonable time frame. A sale is highly probable. In other words, yeah, we're going to sell this, and it's very possible to sell. It's not something that's so unique that you're not going to sell it. There must be a management commitment to sell. Somebody might say, yes, we're going, if the right offer comes, we're going to get rid of this. There must be an active program to find a buyer. What does active program mean? Well, if the assets are advertised through a dealer, that's a very active program. Or maybe they're contacting other operations and saying, do you want this? We'd like to sell it. There's something actively happening. They just don't have it stuffed in a corner someplace, but they're actively trying to find a buyer. The assets must be marketed for sale at a reasonable price. In other words, you got to say, I'm going to accept a reasonable offer for this. It's not something where you say, well, I'll sell it if I get so much more money than it's worth. The sixth point is that a potential sale is expected within 1 year or less, and it's unlikely that the plan to sell will be withdrawn. So for an asset to be held for sale, all 7 of these must be met. So in other words, you have to meet all 7 of these to be able to commit to selling the asset. Now, a situation I had that I just did a valuation on, and I think I might have mentioned it earlier, I believe I did. This client is going into an operation. They're going to move it in a couple of years. When they move it, they're not planning on taking very much of the equipment with them. They're going to probably sell or dispose of most of the equipment. But I couldn't value it under this scenario for a couple of reasons. Number 1, they're not ready for sale. Number 2, there's not an active program right now to sell anything. Number 3, it's 2 years from now, not a year from now. There's a bunch of strikes against them. So we went back and forth, and I said, okay, I got to value this as a continued operation because these aren't met, and they understood that. So if you do something that's held for sale, then you've got to meet all the 7 criteria. So an asset that's going to be abandoned or disposed of should not be classified as held for sale. That's got to be put under a different type of account. So, and also a temporary shutdown should not be treated as the same as being abandoned. So abandoned means we're never going to use this again. It's going to sit there. We can't sell it for some reason, so you're just going to let it sit. That's a total different valuation. And in a lot of cases, the reason it's sitting is the liability of getting rid of it is greater than the ability to sell it. So therefore, it might be more of a liability, in which case your value probably would be 0 or a salvage value. So an entity shall measure a non-current asset at its lower of its carrying value or the fair value less the cost to sell. And also, an entity shall measure a non-current asset classified as held for distribution to owners at the lower of its carrying value or the value less the cost to distribute. So the first one is cost to sell. The second one is like if you're doing an intercompany transfer, if you're taking an asset and giving it between two related parties, or you're trying to distribute it to somebody else that's a related entity, you handle that differently. A loss shall be recognized by the company for any initial or subsequent write-down to fair value, and a gain shall be recognized for any subsequent increase in fair value. What this means, and again, I'm not going to read all of this, but really what this means is, let's say we put an asset for sale for $100,000. If it sells for $80,000, they have a $20,000 loss that they have to account for on their books. If it's valued at $100,000 and somebody pays them $120,000 for it, then they have to recognize a gain. They don't automatically adjust the sales price up and down to either negate a gain or get rid of a loss. What they do is they value it at whatever it's valued at, and when it sells, they either take a loss or a gain. So that's something that they have to consider. So when you're doing a valuation for an asset that's held for sale, it's probably more critical that you get it right as of that valuation date, because you could cause a loss or a gain for a company. If the entity decides not to sell the asset, so let's say they put it up for sale and then 11 months into it, they say, well, we're not going to sell this after all. You don't want that to happen, but let's say if it does, then you have to revalue it. And you revalue it basically at the lower of the carrying value before the asset was classified, or the fair value as of the date the decision was made. So you value it at the lower of the two. So if they pull it back off the marketplace, you take a look at the carrying value that was there before they decided to put it on the marketplace, and then you put a fair value on it, and you value it at the lesser of the two. So when an asset is abandoned, the carrying value should be equal to its salvage value or no lower than zero. So in a nutshell, again, that's several hundred pages into several slides. We've got a lot of topics to cover. Ruka and I came up with a good hit list of things that we wanted to touch upon. So we're changing over to another subject matter here. Goodwill and negative goodwill. And this is kind of a hot topic, and we'll talk about negative goodwill in a minute. But goodwill represents the future economic benefit arising from other assets acquired in a business that are not individually identified and separately recognized. So again, why do you have a business? Why do I have Valcon Partners? I mean, I love doing valuations, and I love serving my clients, and I love giving you guys presentations, but I'm going to let you in a little secret. I like to make money. I have a business because I like to make money. I have a family. I've got college educations to pay for. I got weddings to pay for. I need money to live. So I want to make a profit. You run a business to make a profit. I don't care what the marketing people say. You run a business to make a profit. I mean, do I love my clients? Yes. Do I treat them right? Yes. But the better I treat them, the more I make, which is a good thing. Goodwill is, I have assets. I'm sitting in my office right now. You're seeing Valcon Partners corporate office. It's not that great, but it's here. I've got some desks. I've got some computers. I've got stuff around me. Why do I have all this stuff? I use it to make money. So goodwill is the value above the value of the assets. So if you have an organization out there that somebody's bought for $1 million and they've got $900,000 worth of assets, that $1 million is goodwill. Why does somebody pay goodwill? They pay goodwill because they feel that your product is worth more than the sum of the assets. So the goodwill is the premium paid over the value of the tangible assets. So where does goodwill come from? Well, it comes from things like reputation of the company, what's going on in the economy, but goodwill is also very volatile. So if the reputation of the company varies up or down, goodwill is going to change. If the economy goes up or down, goodwill is going to change. If you have recalls or product quality issues, what's going to happen to your goodwill? It's going to disappear. Goodwill is really an influence externally. So think about this. I don't know how many of you remember the recession we had in 2008, but At that time, General Motors pretty much went bankrupt. Their goodwill essentially disappeared. I think GM's got pretty good goodwill now, but unfortunately they can't write that back up on their books because we don't allow that. What happened during COVID? A lot of companies' goodwill kind of disappeared because there was lots of issues. This kind of shows you graphically what goodwill is. So hypothetical allocation to purchase price of a company that was sold for $1 million. You've got cash on the bottom of $100,000. Next group is machinery and equipment of $300,000. Let's say they own some real estate that's worth $200,000. You got inventory of $50,000. You got some identifiable and tangible assets, some patents and things that are worth $200,000. That ends up being worth about $850,000. But a company decided, I'm paying you $1 million. Well, they're paying $1 million because they feel you've got some goodwill there, so that what's left over becomes goodwill. So let's just take a look at a hypothetical calculation here. We talked about this a little bit. What is the goodwill in this situation? All you have to do is you have to say, here's the purchase price, add up all the assets, subtract them off, and you end up with about $250,000 worth of goodwill. Why don't you just quickly do some math here and then come up with what you think the goodwill factor is. I'll give you just a minute to do that. So the purchase price was $500,000. You got net working capital or cash about $1 million. You got some intangible assets worth $2 million, $1.2 million of real estate, $500,000 of personal property, and $250,000 worth of assumed liabilities. What do you feel the goodwill value is in this company? Give you a minute to do that. All right, so all you have to really do is you add up all of the stuff on the bottom, subtract it off your 500,000, 5 million, excuse me, and you end up with about $550,000 worth of goodwill. So that's a pretty good transaction. I mean, if you're in a situation like that and you get that much goodwill, that's a pretty good situation. Now we're going to discuss kind of the real negative. What is something called negative goodwill? Well, we know what goodwill is. Goodwill is what the value of the company is above the tangible assets. What is negative goodwill? Well, negative goodwill, I use that falling down, you see, because it's a negative. Sorry, bad PowerPoint joke. But negative goodwill is when the total of all of the assets is greater than the purchase price. And this is called a bargain purchase. Now, I'm seeing this quite a bit today, where I'm seeing companies that are actually being bought for less than all the value of all their assets. Now, why would that be happening? It could be that maybe they've just got a lot of old assets that they're trying to get rid of. You've got a lot of companies that are facing financial issues and they need to get cash to get out of it. I will tell you that accounting firms hate negative goodwill. They don't like it. And you know why they don't like it? Because it creates an automatic capital gain on the part of your client. So they will do everything they can to get rid of negative goodwill, but it does happen. So it sounds really weird. Why would you sell a company for less than the value of all the assets? Well, like I said, I went through a couple of reasons: financial problems, bankruptcies, people wanting to retire and just get out of it. There are reasons to do that. So here's an example of a situation where, you know, you've got $11 million worth of fair value of the assets and you've got $9 million purchase price. So you've got a $2 million negative goodwill. If you do this example, why don't you give that example up real quick? What's the negative goodwill here? Ironically, it happens to also be $2 million. I didn't really plan it that way, but it kind of worked out that way. So we get the situation where, you know, the accountant goes, you're probably going to first find this out when you talk to the business enterprise valuation person or the BV person, and they're going to say, Doug, we got a problem here. The purchase price is actually lower than all the assets. You must have done your job wrong. And they always blame the machinery and equipment person, which is not the right way to do it, but they always do. And sometimes they blame the real estate person, but usually it's the MTS person that gets thrown into it. But I say, well, let's go back and look at everything. So how do you handle this? Let's say you get to the situation and you need to look at it. What do you do? Well, you review your analysis. Did I take all my depreciation and obsolescence accurately? Are there any additional obsolescence factors that maybe I need to consider? Do we need to look at in exchange versus in use? Remember we talked a little bit about that? Now let me tell you something. Two things. Number one, just because there is negative goodwill does not mean that you did something wrong as an MTS appraiser. You could be very correct. There could be other issues at play here. And what your decision to make is, did I do my job properly? And if you did, then you go back to the BV person or the company and say, I did my job properly. You got to make some other adjustments, or we have to do this another way. So you can't just take that loss and just allocate it among all the different assets. That is not allowed today. So you have to take a look at some other areas. So to decide which premise to use, remember we went back and we said, okay, in use versus in exchange, we're looking at the same thing we did before. We're looking at what is the most advantageous marketplace, what's the typical market participants, what would they do, what's the highest and best use. If the company's losing money, you may decide that it makes more sense to dispose of the assets, in which case you're going to do a value in exchange instead of a value in use. So you could consider that. The first thing I would do is, if you think you did all your valuations properly, go back to the company and go back to the auditor and say, I'm going to start pulling off some of those direct and indirect costs, and I'm going to go in exchange. But don't just do that without discussing with them, because again, they don't like you see that word in a value of a business that's operating. Maybe there's assets that are idle that you need to lower the value on, leave the production assets here, but maybe there's assets you need to lower the value on because they're not being used. Maybe there's a group of assets, maybe the reason that you got this bargain purchase, there's a group of assets that are held for sale that you weren't told about. You got to figure that out. So what is the appropriate value premise? We talked about the fact that you always call it fair value. But what is fair value? Remember we talked about IAS 36 being impairment. IFRS 5 is held for sale. So that's going to be the lower end of the value spectrum. Fair value has got a valuation spectrum. It's not one number, it's a spectrum. So you need to look at some of these different things. What would the market participant do? So what is the lowest you can go? So what is the lowest premise of value? This is not a defined term, but it's an accepted terminology. It's called orderly piecemeal disposition, or orderly disposition value. So what orderly disposition value means is that you're valuing the assets assuming a piecemeal sale of the assets. In other words, you're assuming that you're going to sell all of these assets on a one-by-one basis, not as a group of assets. That is the lowest you can go. So when somebody says, you know, you've got a lot of negative goodwill here, you can bring your number down, but you can go no lower than what you could sell the assets for under an orderly disposition value. Now, one thing to keep in mind is that that does not mean a forced sale. Remember, you cannot use a liquidation or forced sale. So you've got to go down to some orderly disposition value. So what is it? What does this mean? There's two different camps. And this has been a point of discussion. So orderly, there's two different people or two different concerns. One says that's a hypothetical sale of the assets under a quick time frame with some compulsion. However, the asset is being used by the company, and thus there is some value to the things that you might value at zero under a true orderly disposition number, like leasehold improvements and things. And there's another group that says, no, it's really supposed to be orderly liquidation value, which means things like leasehold improvements would be valued at zero. So there's two different groups here. I kind of disagree. I'm more the first way, that if the piece is operating, there's still some value to some of those intangible things. we're hitting the 3-hour mark. I'm hoping to be able to be done in the next half hour. Thank you very much for sticking around. If you have to go, I totally understand. But we've got some very interesting topics coming up that I think will answer a lot of questions and I think will be of value. So if it's okay with Ruka and Mustafa, I'm going to keep going. I'll take that as a yes. Okay.
Yes, please.
All right, thank you. Now we're going to talk a little bit about the evaluation team. Remember early on, I made a comment that what we're doing here is we're valuing an asset and we're using a team of valuers. So what are the building blocks of a purchase price allocation? You've got machinery and equipment, real estate, and inventory. Those are the tangible building blocks. Then you've got things like the intangible values and a workforce. Those are the intangible building blocks. And then on top, you've got goodwill. So all of these pieces are part of the valuation. So who are you going to have on your team? Your team is usually going to be led, usually, not always, but usually led by the business valuation person or the intangible valuation expert. Then you're going to have you doing the machinery and equipment. You might have some personal property. You're going to have some real estate. You might have some inventory. But what you're going to do is you all have certain pieces of the puzzle that you put together to come up with the value of this company. So a few things to keep in mind when you're doing this is that you can't do this in what we call a vacuum. So in other words, you just can't do your job, have the real estate person do their job, have the inventory person do their job, and just put them all together and just say, we're done, ready to go, perfect. It doesn't work that way. It doesn't work that way because you've got to keep in mind the value of the company. Now there's two, we've already hit one value of the company, which is the purchase price. There can be another value of the company, which is what the business enterprise person will calculate, which could be greater than or less than the purchase price. But that's another thing you got to keep into consideration. So who do you get that information from? You've got to get that from the business enterprise valuer. So all of these kind of interact together, and you've got to be cognizant of where is the math leading up to? Are we higher than the purchase price? And if so, does that make sense? Are we lower than the purchase price? If so, does that make sense? So you've got to be in constant communication with all the different parts of the team to make sure that you're doing everything properly. And it's very important, for example, if you're going out and doing a process plant, that you're very integrated with the real estate person to make sure that you're not missing assets and not double counting assets. I'll give you an example of something I'm going to go out to do next week. I'm going out to do it's a relatively small process plant. They process oats, but they've got these large bins that store the oats. Underneath the bins is a big concrete pad. Now, on the fixed asset record, I've actually got what they cost to do this pad about 3 years ago. So I could very easily value that pad. But there's a real estate person doing the real estate. So I have not talked to the real estate person yet, but yesterday afternoon, I sent them an email and I said, I want to talk to you about what you're doing, because if he's valuing that pad, I don't want to value that pad. And there's always a chance he might take those bins. I don't know why, but I want to make sure that we're very clear. He's taking this, I'm taking this. So you got to make sure you're interacting with each other. And communication is key all the way through this. The other way that could be a difference is there could be economic obsolescence that you as a valuer are not capturing, but the only way you're going to capture it is if you go through and get it through a business enterprise valuation. So that could give you an idea that there's some economic obsolescence that you are not capturing. So one of the other things that's very important here is that you cannot assume earnings. You cannot say, we assume that the values that we're giving you are appropriate and that they are supported by the cash flows of the business. Under financial reporting valuations, they have to be proven one way or the other. There has to be some sort of business enterprise value done. So if you were approached to do one of these as a machinery and equipment person, and if you're not doing the business enterprise value, you need to ask, is there somebody doing the business enterprise value? Because that has to be done. You have to prove that earnings do or do not support. Some different things here to consider. We talked about this. The reporting cannot be done in seclusion. The team must be in constant communication. BV is usually the team leader. The valuation can be an iterative process. You might come up, and this is why you might want to charge a little bit more or do it a little bit more of a range, because it might be a reiterative process. Constantly, I'm being asked by my business valuation person who's putting everything together, where are you at? Where your value is going to be? Are you close to net book? Are you not? Where are you? And I may tell them where my values are, and they'll go, great, fine, keep going. Or, oh, we might be getting into a part of a bargain purchase. You may want to consider things a little bit. So if you're close, let me give you a little bit of a hint. It's a little inside baseball, as we say here. If you always ask if you think there's going to be a bargain purchase, because if there is, or if you're even close, you're going to have to come up with multiple valuations. Whenever I think there's going to be a bargain purchase, I come up with, and again, I'm sorry, I'm talking American football here, not what you guys, we call what you guys call football soccer. I know that's wrong, but we call it soccer. But in the football, we have guideposts. We have something that the ball goes through. So we call them goalposts. So I come up with the goalposts. I always come up with a market value, and I come up with an orderly liquidation value, because then I know I've got freedom to move in here, and I know I can't go any lower than this. So I'm always coming up with two values if I think there's a bargain purchase, because then I know how low can I go and where's the highest number and where can I go in between there. If there's not going to be a bargain purchase, I don't care about this lower end. I'm fine at the upper end. So it takes a little more work. So let's talk a little bit about the team, and what do you, as the machinery and equipment valuer, what do you give back to the team? Well, this is what you give them. You give them credible fair value indications. What does the word credible mean? That means reliable and supportable. Supportable is a huge factor in these. And why is it a huge factor? You're going to find out later. But your work goes through audit, so it's got to be credible, reliable, and supportable. Credible orderly disposition value if it's needed, credible open balance sheet values, and credible remaining useful lives. So what are the remaining useful lives used for? Well, a lot of times, and I always tell my clients, don't do this, but they'll do it anyways. They will take the remaining useful lives and they will depreciate the assets over that remaining useful life. That's what they're going to use for their books. Can't stop them from doing that. The business valuation folks use it in their internal rate of return valuations. They use it in their weighted average return on asset or the WARA calculations. So their WAC calculations, they use the remaining useful life. So there's a good chance they're going to ask you for that as well. So you can give credible opening balance sheet values for the return on investment. You can be boots on the ground. And what I mean by that is a lot of times the business enterprise valuation person will not visit the plant and they may not even hold interviews. And let me give you a situation where my boots on the ground actually saved some embarrassment on the BV people. I've done it a lot of times, but they don't admit it. But I was doing some work in Italy for a company that made glass for the automotive industry. And the BV person was using their past cash flows to forecast their future cash flows. And I happened to be bored, so I was working at home, and so I happened to call her, and I was walking around the neighborhood a little bit on my cell phone, and I said, hey, we got this. She goes, hey, we got this problem. We've got a possible a bargain purchase. And I said, what do you mean we have a bargain purchase? And she goes, cash flows they're not showing up where I think they need to be. They're not supporting the purchase price, and we got this cash flow issue. And I said, do you realize that they just bought out their largest competitor? And she said, no, I wasn't made aware of that. How was I aware of that? I took the plant tour with the plant manager and with a couple other people, and he was pointing out all the equipment they just bought. Well, they bought some equipment. What else did they buy? They bought a customer base. They were projecting a huge increase in their sales and a huge increase in their income. Why the person doing the business valuation didn't discover that, I don't know. But all of a sudden I said, hey, you may want to call them and you may want to discuss this with them. So she goes, I'm going to get right on it. She called them. She calls me back and she goes, you just saved me a bunch of embarrassment. There went from being a potential negative goodwill to a huge goodwill because they just inherited a whole nother marketplace that they weren't made aware of. So being boots on the ground, you can be a good person to tell the BV people what they need to know. Same thing with that bakery that I just did where I found all those assets that were idled. I value them as they were idled, and the business valuation person needed to take a charge against that. So again, my knowledge of boots on the ground helped them. So we can give them some support. What can they give us? Well, they can be a bridge to the client and the auditor. Usually it's the business valuation person that has the relationship with the auditor, and they've got the relationship with the client. They can be a great source of business for you. They can help you based on calculate economic obsolescence. Other than that, they can also give you assurance that your values are good. If there's plenty of value in the company, they can tell you, yeah, everything's great. They can also, remember I told you how, we've got to sometimes couch or take down our expected lives, depending on maybe if something's going to be discontinued. It's always good to have a discussion with your BV person and say, do you know of any of these product lines that are going to be discontinued? Because the company might share that with them, but they might not share it with you. So if all of a sudden you realize that a product line might be discontinued, your age that you use, your normal useful life, may be dropped. We talked a little bit about this. Communication is paramount. You want to talk to the real estate person, make sure that things like cranes, spray booths, equipment enclosures, portable buildings, who's covering those? You might have a situation where this doesn't happen a lot, but I've run across this where, I did a hotel that had a lot of antiques and collectibles and artwork. I had to get an artwork appraiser involved. I had to get an antique appraiser involved. I just did a valuation of a company that had a transportation company. He happened to have a small car collection that was part of the company. I had to hire an antique car guy to do those valuations. So there are people that you need to get involved. So when you put everything together, one of the main questions you have to ask is there economic support? What does economic support mean? The value of the company is at least equal to or greater than the value of all the assets. Are there assets that are held for sale? Is there a bargain purchase? Is there potential economic obsolescence either at an industry level or a company level? The BV person will probably know that. You might not know that. So very rarely can the fair value of all the assets be greater than the purchase price. It can happen. We talked about a bargain purchase. Very rarely does it happen, but it can happen. So now we're going to switch subjects a little bit here. And we're going to go into some of the reporting requirements. So now you've done your work. What should your report include? You're trying to get your report. You want to make sure it gets to the auditor, make sure your client's happy. What does it need to have inside of it? Well, first of all, depending on where you're doing your work, if you're doing your work in the United States or in Canada or Mexico, you want to make sure that it meets USPAP requirements. If you're doing work in Saudi Arabia or Africa or Europe, you're going to want to make sure you follow IVS standards. You want to make sure that you're using fair value appropriately. Always, always, always call it fair value, regardless of what you're really doing. But then you got the in exchange, in use, and orderly disposition value. You need to take your fair value, and then you need to qualify it or quantify it and say, I'm doing fair value under this premise. And you might even want to quote the IFRS standard and say, this is the definition of in use. I'm using this. Or this is the definition of orderly disposition value. I'm using this. You want to make sure that you're using the appropriate standards. You're quoting IFRS 13 properly. If it's held for sale, you're quoting IFRS 5. Make sure you're quoting the appropriate standards and using them properly. You need to discuss how you validated whether or not there was economic support. Was the purchase price above the value of all your assets? Did the business enterprise value company come up with a value that's greater than all your assets? How did you validate whether there's economic support? If there's not economic support, what did you do? If there's negative goodwill, how did you handle it? You must also outline the data reviewed and utilized. What did you look at? You looked at fixed asset records. I went to these 5 sites. I used this market data. I used this market source. What did you do? Outline the sources for trends, depreciation, and market data. Where did you get your trends from? Now, I happen to know that Saudi Arabia's got some okay trend data. It's not the greatest, but there's some data out there. Did you use that? Did you use US trends? We had the question earlier about exchange rates and other trends. Where did you get your trends from? Outline the approaches to value. And why did you use that? I used the cost approach because. I did not use the cost approach because. You got to justify what you did and what you didn't do. Remember, we talked earlier on, and I know that's almost 4 hours ago, and I'm starting to get tired. I'm sure you guys are too. Sorry to do this over dinner hour, but remember a summary of cost basis, net book value, and fair value, at least on an aggregate basis. Remaining useful life, we talked about that. So you get a report. You get your report done. You cover these 10 steps, whatever else you did. You summarized everything. Everything's great. Where does your report go? It goes to an auditor. This is probably the most scary part of any fair value, but it shouldn't be. So why are these reports reviewed? Well, they're reviewed because they have a direct impact on the client's financial statements. We already talked about that. That is going to go on the financial statements. So the auditor is going to look at your work just like they would anything else that goes in the financial statements. Were they performed in compliance with the appropriate standards? So, and the question about what do you do, what could you do wrong? Hoping the person's still on here because we're going to hit that in a couple of slides. So who performs the audit review? Well, the audit team or the audit partner is the person that signs off on it. They're not valuation professionals. They usually have somebody that's called a service provider that actually is somebody that knows what you're doing. I hope that they do that, because usually the person to review your work is somebody at their firm that does the same thing you do. So hopefully, I'm sure there are some people on this call that are affiliated with audit firms that do some of this review work. So hopefully you're reviewing work that you understand. So usually they're going to review, somebody with MTS experience or machinery and equipment experience will be reviewing your reports. They're going to ask you some questions. And what are they trying to do? Are they trying to give you a hard time? Usually not. The only time I've had auditors give people a hard time is when the appraiser was not doing what their job properly and becoming obstinate or stubborn. So let's talk about what are they really trying to do. This is what they're really trying to do. They're answering these questions. Does the valuer appear to possess the necessary qualifications and experience to do this valuation? Are you appropriate to do it? Are the objectives and scope of the appraisal appropriate? Are they appropriate for a purchase price allocation? Are they appropriate if it's under an impairment? Make sure that they're doing the appropriate thing there. This is kind of really worded weird. Is the valuer's relationship with the client not inappropriate? What does that mean? In other words, is the valuation relationship independent from the client? Are they independent? Do they not have any kind of influence from the client? That's a big thing. They want to give you an unbiased opinion of value. Is the valuer unbiased? Do the methods and assumptions appear to be appropriate? You use these assumptions. Again, going back to maybe they have assets that are held for sale. If you didn't know that, and all of a sudden that gets identified to you, that could be a problem. So maybe you have one of the assumptions that I assume everything is operating. Well, the client may come back to you or the auditor may come back to you and go, well, no, we got a whole bunch of assets here that are not under that assumption. Do the form and content of the appraisal appear appropriate? Would it be appropriate to use the appraisal as audit evidence? That's probably one of the biggest things because they're using audit evidence. You give your values to the client gives them to the auditor. You are by proxy, the client is using you as a proxy for their input. So is this appropriate audit evidence? I think you're starting to decide that maybe something like this takes a little extra time because you're going through the review process. It really does. And so I always tell my clients, this many hours are going to be dedicated to the appraisal or the review process. I'm going to cover up to that. If it's above that, we're going to charge you extra. Or maybe you say it's charged on the hour or whatever it is. Very rarely have I gotten an audit back to say change something. I've been challenged many times, but usually we come to an agreement or they come to an internal agreement that, yeah, maybe we don't like Doug's numbers, but they're not materially different. So what are they going to get up front? So from you, first of all, I'm going to give you one point. Never, ever, ever finalize a report until it's gone through review. Always keep it in draft format, because there's always a chance something might change based upon maybe some information you did not have that the audit team has that's going to make you go back and do more work. So again, if it makes you go back and do more work and it's not a mistake on your part, you're probably going to want to charge the client more. But never, ever, ever go final. Always go draft until you get approval to go final. And I've had that backfire on me a couple times. Recently, I had a client say, go final, and I went final. And then literally 3 days later, I get an email from the auditor going, I'm auditing this. And I went, wait a minute, you're supposed to be done. And they said, no, we're not. We're just starting. Thank goodness there were no changes to the report, because once you finalize a report, it's difficult to take the information back. But what is the client get? What are they going to give to their auditor? They're going to give them the report and whatever Excel spreadsheets you give them. That's going to be their first thing to do. They're going to review that. They're going to come back to you with questions. They're going to ask for your valuation worksheets. They're going to ask for your valuation model. They're going to say, how did you get from step A to step B? They're going to ask you for that. They're going to ask you for certain parts of your work file. They probably won't ask for your entire work file, but they're going to ask for your file. They're going to ask for certain parts of your analysis. If you have any memos in there, or any comparables, or any, they're going to ask you for a sample of your market data. Where did you get your trends from? How did you arrive at your lives? They're going to ask you all this information. I can't overemphasize this. Cooperate to the best of your ability. Do not say, I don't want you to look at this, whatever. A lot of people on this call probably have many, many years experience. The person doing a review, they might be a couple years out of college, but they're just doing what they're asked to do, and they're not trying to trick you. So what is the task of the reviewer? The task of the reviewer is to take an independent, unbiased look at the appraisal. They need to verify the data used. Now, when they say verify, what do they mean? If you have data and they ask for it, if you have comps, give them the comps. If they have to research the comps, it's going to take more time. And what did I say earlier? The audit team probably charges more per hour than you do, so therefore you're costing your client money by not cooperating. They need to verify and validate the valuation technique. Did somebody use the cost approach where they really should be using a market approach? They want to make sure that. They want to evaluate your assumptions. They want to evaluate that you did the right process. They need to evaluate whether the fair value measurement was properly determined using the data that you were given. They're reviewing the results for consistency. This is a big deal. You need to make sure that your values are consistent. They're going to do something called sensitivity testing. They're going to take the data that you got originally, and they may run another valuation, or what they call a shadow valuation. And they're going to compare that result to your result. And they better come somewhat close, or they're going to have lots of questions for you. So what do they expect from you? They want you to produce a report that is understandable and which outlines your scope of work and methodology. The report should also outline any assumptions you made as an assets held for sale, plant closures, that type of thing. They want a valuation summary, which shows a comparison of cost. They want a detailed listing of valued assets. They want responses to questionnaires they provide, including general and specific questions. They may want a conference call or two to go over these answers. One thing I can say, and this is big, cooperation is huge here. Make sure that you cooperate. Now, I've often heard of stories, and I'm hearing less and less about them, about valuers who say, I can't give the information out, it's proprietary. If it's truly proprietary information, then you can probably get then you don't have to release it, or you can maybe get an agreement from your client to release it. But really, what we do, you shouldn't be using any proprietary information. If you got market, let's say you did find some proprietary information from a dealer, they gave you an invoice and said, I sold this a piece of equipment XYZ for this amount of money. That's proprietary information that you shouldn't share. And you could tell them, look, I got this comp in confidence from a dealer. I can't share it. If they insist on it, then what you can do is you can cross off the dealer's name, cross off the company that it's sold to, just give them the pertinent information of, here's an invoice, black out all the confidential information, and just give them the invoice. That'll be so much better. So, and again, their job is not to, their job is to challenge you. Their job is not to discredit you, but their job is to try to get you over the finish line, and they want you to succeed. They don't want to have to do a evaluation over and over and over again. So what is a good working file? And we're getting really close to what the problems are, and we're going to talk about those in a minute. But a good working file will allow you as a valuer to quickly and efficiently gather the appropriate background data. So if somebody asks you, what did you do? You can very easily gather that data. Now, keep in mind, the review process is going to happen significantly later than the valuation process. I just had a review that took over a year to get back to me and ask me questions on it. So they had it in their files for a year, and they finally started asking me questions about it. So I think I do a pretty good job file. I mean, there's always things that can be bettered, but I was able to go to the project file and they said, I want this, this, and this. I was very easily ready to, I grabbed it, I scanned it, I sent it to them. So in a job file, you need to make sure that you can very quickly and efficiently gather all your information. So what should be in a job file? This is just a brief listing. And again, you're going to get this listing in your student manual, but any market comps used. And what I mean by that is print out the actual market comps. I had an individual several years ago call me, and unfortunately, they were going through a review of somebody that had quit the company. And they said, we got a problem. And I said, what's your problem? He said he had a link in the Excel spreadsheet to the comps on each one of his assets. But guess what? This was a year later, and all those pieces of equipment were no longer for sale. So you click on the comp, it takes you nowhere. So never put in a link to a comp. Always print it out, PDF it, somehow keep a copy of that, screenshot it, always keep a copy of it, but also be able to get back to that comp that says, here's my, I page number everything, different page numbers for different things. But if somebody says, show me what you did for this asset, I can go to my 3 or 4 comps and I can say, here they are for that specific line item. They're going to want to see the trend and depreciation data. Where'd you get the data from? They're going to want the source. So write down the source, document the source in your Excel file. What did I do? They're going to want to see the actual trend and depreciation tables. They're going to want to see your obsolescence calculations. If you have a talk with a dealer and you scribble some stuff down on a piece of paper, keep that piece of paper. If you want to, my writing is terrible. A lot of times, if I go more than a couple of sentences on a piece of paper, I retype it into another document. I keep that document. Cross-referenced report. They want to make sure the numbers make sense. Make sure the numbers at the front of the report match the numbers in the back of the report, match your summary. That summary matches all your backup data. Any field notes, any data received from the client. Those are all things that need to go in your file. Now the question that really wants to get asked are, what are some of the problems? What are some of the issues that we reach? And yes, I kind of saved this to the end. This is kind of my, hopefully you stuck around for this because this is kind of important. So these are things that if the auditor starts seeing some of these are things that might make them go, we need to dig a little bit deeper. So these are things that you may want to really make sure that your reports do. Number one, do they meet the International Evaluation Standards or USPAP if you're working in the United States? And alternately, are they meeting the right standards? IFRS 13, IAS 16, 15. What are they doing? Are they meeting the right standards? Inconsistencies in the work product. In other words, your electronic file doesn't match your report. I've had situations where the write-up in the report says one thing and the values say another, meaning they do this, the economy is doing great. Everything's fantastic in this industry. But then on the report and the values, they go, well, we're valuing everything at liquidation value. That makes no sense. The valuation date is not the transaction date. Keep in mind, the valuation date has to be the measurement date. The measurement date has to be the transaction date. And remember, they're retrospective. And so typically, I will even label my reports, retrospective valuation of, as of June 13th, 2022. I will specifically put retrospective dates in there. I will say it's a retrospective. That's something that's very important. Other red flags: no indication or verification of changes in the assets. In other words, if you get an asset record, let's say the valuation date is June 21st of 2023, and you get an asset record as of August 21st, 2023, what did you do to bridge that difference? Alternately, if the valuation date's in June and you get an asset list from January, what did you do? What due diligence did you do to breach that difference? Usually I put a very minimal thing in my report about, I spoke to management, we discussed this, blah, blah, blah. But then I may have a more detailed memo in my file, or I will show things on the Excel spreadsheet that are more detailed about what we did to change that. Valuations that are not tied to the fixed asset record, using the incorrect value premise. In other words, valuing an operating asset at orderly liquidation without meaningful support, valuing an asset in use when it's really idled. So those are some things that you might want to watch. Value is stated other than fair value. You valued at a liquidation value, you defined fair market value. These next two are huge. And I want to be very careful about these. And I want to be very blunt about these. I see this a lot. And unfortunately, I see this a lot with certain valuation companies. No consideration of obsolescence at all, or over consideration of obsolescence. So where'd you consider it at all? Because you just do a simple, and this kind of leads into the next paragraph. You do a bend and trend, you do a trend and depreciation analysis, and you just say, well, we didn't consider any obsolescence because either it wasn't part of our scope, or we didn't identify any, or whatever. But you didn't actually go to the marketplace to check. So you just blindly did this, and all of a sudden you come up with a number that really doesn't make sense. Or over consideration. I'm sure a lot of you are familiar with what's called the inutility calculation. Again, if you use inutility, make sure that you do not go below orderly disposition value. I see a lot of valuations where they do an inutility that takes the value of the asset below what you could sell it for at an auction. And that is just bad. That's just bad. That's just terrible for an appraiser to do that. Sorry to say that, but I see a lot of that. So if they're auditing you and they see that could be a problem. Blindly looking at factors, the valuer not being cooperative, or just saying, look, I can't give you information, or on the other one, I don't have information. If you don't have information, you're not going to be able to do anything. Abnormally long lives. I've seen this too, where people value something at net book value, and they don't really give an explanation as to why. So those are just some red flags. So what can you do to make the process go smoother? Number one, this is huge. If you can, have a discussion with the valuation team and even the auditor and the client before you start your work. Uncover all these different things like idled equipment held for sale. I just got a call the other day from a client that said, I got a plant in Georgia and a plant in China. What am I going to do about the plant in China? I have to do a lot of research. I'm not going to go to China because it's a really small operation. I also don't happen to know anybody in the province where he's going to be, so I can't hire somebody there. So I'm going to have to gather information. That's probably going to be the biggest challenge, is the stuff in China. So I'm covering that. If there's anything that comes up, like a potential bargain purchase or assets held for sale or anything like that, come up with a game plan and then go back to the team again and say, this is how I plan on valuing this, unless you come up with some other ideas, so that everybody's on the same page. Because the worst thing that can happen is you value something inappropriately, then you get through the audit process and they say, oh, what about this? Or why did you do that? And then all of a sudden you got to go back and redo your numbers, which if it's on you, if you did a mistake, you probably cannot charge anymore for your time. So that looks bad on you, looks bad on the client. The client ends up having to go through and pay more money to the auditor. Prepare your valuation in a transparent manner. Again, be cooperative. There's been 2 or 3 times, well, maybe more, but I'm only going to admit to 2 or 3 times, where the auditor comes back and says, Doug, you made a mistake. Here's you did some math wrong, or why didn't you look at this, or why didn't you look at that? And if they're right, I'm going to go, yeah, sorry, you're right. I don't have an ego. I don't care. If they find something, that's great. Client wasn't happy one time they did it, but my numbers didn't change drastically. But if you do something wrong, admit it. Last slide. Be able to and be willing to provide them with anything that they want. The auditor can be your friend. I've got several auditors that are now some of my best. They actually give me a lot of work because they say Doug's easy to deal with. So that's something you need to consider. Is you help them, they help you. Be honest and open. If you do something wrong, admit it. Document every fact and assumption that you're comfortable will stand alone. In other words, if you make an assumption, write it down and say, look, I did this assumption. If this assumption's wrong, then my valuation might change, but this is how I did it. Recognize that they also have standards and that they hold, they actually, the accounting companies, at least the accounting firms in the US, are reviewed by another entity above them, and they get beat up a lot more than we do. So in conclusion, the best way to get through an audit is just consider the review akin to an audit. As long as things go smoothly and as long as you meet the appropriate standards and all questions are answered, it should go rather smoothly. When the reviewer discovers inconsistencies, they tend to dig deeper. So try to do your best to get in front of some of those things. And if you think there's going to be a problem, if there's something that I'm doing that's different than what I think they will want, I will write a memo to say, this is why I did it and how I did it. It's not part of the report. The client doesn't need to sign that, see that, but I make sure the auditor sees that. So we covered a ton of information in the last 3.5 hours. I see at least 11 questions. We've dropped about half of our participants. I'm sorry. So Ruka, would you like to blow out some questions?
Okay, Mustafa, you can start with the Arabic questions.
Yes, Ruka, thank you very much. We have a question asking about if there are some machinery are for sale. Do we consider them the base of value to be fair value? If we they're for sale, I'm not sure about the question. If he meant the inventory of machinery.
So let me answer the way I think it's being asked, and if I'm wrong, I apologize. Mm-hmm. I think that what the question is if we have some equipment for sale, and if it's an asking price, can you consider that evidence of fair value? And the answer is yes, as long as you know a little bit about it, and as long as it's not. So yes, I use asking prices as evidence of fair market or fair value frequently.
Yes. So only one question in Arabic. We have a couple questions in English.
Okay. For the translator, I apologize again for being so speedy.
Someone is asking about refurbished machinery. How do you evaluate them and the useful cycle life? I think we do have. I don't know, Douglas, want to answer this because we do have a upcoming webinar about this topic.
Well, there's a webinar about refurbishment, and wow, I'd like to attend that one.
No, it's about the useful cycle life of the machinery and equipment.
Okay. Well, the answer to the question shortly is usually when you have a refurbishment, it will decrease the useful life, and there's a method that we use in the American Society of Appraisers called a weighted age that helps you calculate how much age it gives back. And again, I don't mean to be too pushy on the book, but if you get the appraising machinery and equipment, there is an example in there about how to use a weighted effective age. So,
okay. One more question is asking about if you have in the market different data about the prices of the machinery equipment. Do you consider taking the average of the prices?
If you're saying different dates or just different pieces of equipment?
Data about prices.
Data, okay. That it all depends. If I find, usually what I try to do is if I have like 6 or 7 pieces of data, I will try to find the one that matches my comparable the best and rely upon that one. Now, if you've got like, let's say you're looking at a forklift truck and you've got 7 or 8 different comparables and they're all similar in hours and similar in age. Yeah, in that case, you might want to take an average. I wouldn't say taking an average all the time is the best. I do it on occasion. So the answer is sometimes. Yes, okay. It does happen.
Okay. There is a question asking about how do you handle the time frame between starting your appraisal work till submitting the final report. Since you mentioned about the report need to be reviewed before submitting the final version of the report. When you get sometimes pushed by or asked by the client to submit the report as soon as possible.
Always. Clients are always in a hurry, and usually one of the first questions I ask when I'm get a phone call is, what is your time frame for me to get a report to you? And if there's been times, and I hate to say this, but there's been times I've told the client I can't do that. And if they're too pushy, then I'm just like, I can't do that. And we usually come to an agreement. And there have been times I've lost work because I couldn't get it done fast enough, or I could get it done, but I wouldn't be confident with the work. And usually I'll hold them to that. If they say you've got 2 weeks, I'll be like, okay, I can do this in 2 weeks. But then when they come back to me a week later and say, are you done? I'm going to be like, no, you told me 2 weeks. So yes, there are times when you get pushed. When you get pushed, you can either do one of 2 things. You can say, I can give you what I have now, which I wouldn't really recommend because usually that's a lot more of a variable number. But you can just say, look, I need a little more time to get this done. And you paid me to give you a credible result. I need more time to give you that credible result.
Okay. One question is asking about why do old machines are better and high value than the new brand machines?
I love questions like this. Why are older pieces of equipment more valuable than newer pieces of equipment? Really, it's not older versus newer. It's the quality versus being built with less quality. I'm not going to say that all old equipment is better quality than new equipment, but it comes down to, in some cases, a lot of business owners want to keep that old piece of equipment because it operates so well and it does so well. And let me give you a good example. I did evaluation several years ago, and I saw a Chinese piece of injection mold equipment. And I called one of my best buddies that does a lot in the injection mold equipment, and he says, oh, that's a piece of garbage. He says that's just the biggest piece of junk. He goes, it's a copy of a German machine. He goes, it's awful. I would never buy one of those. I would never sell one of those. And he says, it's not worth anything. Well, I'm going to tell you something. He is now their biggest rep. He sells more of them in the world than anybody else. Why? Because they improved their quality significantly. And now he markets them as the best machines in the world, even over some German pieces of equipment. So it's really what is the quality and what is the reliability more than the age. But a lot of old equipment, the reliability is just there and it'll keep doing what it's doing. New equipment, not built as well, no matter where it's from. And I could care Asia, Pacific, India, US, newer equipment's just not built as well.
Okay. There is also one question asking about when you're doing evaluation, do you evaluate all the machines or you evaluate each machine individually?
It depends what it is. If you've got 30 pieces of equipment that are all individual pieces of equipment, then I value each one and then I add them up. If you have a process line or a paper mill, which is one, in a paper mill, you've got about 10 pieces of equipment that are one piece of equipment. I would value that as a line. So it really depends on what you are valuing and how integrated it is. The more integrated it is, the more chances I would value it as a system. If you're doing if you're doing a chemical plant, then you might want to value each individual system within that plant. You might not value each piece within that system, but you're going to value each system as an individual piece of equipment or piece of asset.
Okay. He's asking about should the auditor review the work paper that the valuer did before he doing his report? What is the best practice?
Should the auditor review the work papers before you do the report? No, absolutely
Yes.
not. Absolutely not. You should discuss what you're doing with the auditor and how you're going to do it, but the review should take place at the time that they're reviewing the report. You don't. If you get them involved too early, you're going to cost your client a lot of money, and the auditor's not going to want to do it. The auditor cannot. It's weird. The auditor cannot bless your work, and they cannot say you did a great job. They can't do that. They can only say this is what you did. We agree or disagree, and they can't. They're not. If you say I want you to approve. I want you to say I can do this. They're not going to give you approval to do that. They're going to say use your best valuation. I mean, I've gone to auditors before and say I want to take this obsolescence hit. Will you support that? And they're going to tell me you do it. You figure it out. If it makes sense, we'll accept it. But they can't say I agree with you. They can't do that. Conflict of interest.
He's asking about how can you make sure that the cost approach is credible, supportable, and accurate.
Okay.
Give us a brief example of how to use the cost approach, estimate the fair value.
Excellent.
Yeah, and what are the inputs in the calculation and the sources? Yes.
Wow. Okay, so the question started being an easy question to answer. Then it went into this like 2-hour webinar. Okay, so the cost approach, really, you start with the replacement cost, which you're going to get from either trending or you're going to get from a dealer. You're going to depreciate physical depreciation, which means you're probably going to do some sort of an age life analysis or some other thing, or maybe by observation. You're going to do functional obsolescence, which is going to be measured using any one of probably a dozen methods, from inutility to technology to a bunch of other things. Economic obsolescence, same thing. There's a lot of different ways to quantify that. You're going to take your replacement cost, subtract physical, subtract functional, subtract economic, and you come up with your fair value. Now, how do you know that's credible? So the way to do that is you're going to do your cost approach on, let's say, everything within a bucket, within a certain group of assets. You're going to take a certain number of those assets and you're going to go to the marketplace. And you're going to say, what are these things actually selling for? Now, if you're doing 1,000 assets, are you going to do 1,000 market checks? If you can, the answer is yes. But if you've got 1,000 assets that are very similar, you might take a section of that and say, I'm going to do a sample of 100 assets. I'm going to get market values on those. And then what you're going to do is you're going to create an adjustment to those 100 assets based on the market value, that you're going to adjust the rest of your 1,000 pieces by that. So that's a way of doing an adjustment. And again, I could do an hour webinar on that too. So.
Okay, there's a question. If I've been asked for a financial reporting valuation, do you have to report the replacement cost too? If so, why?
Okay, I don't know. I'm not an expert at accounting within Saudi Arabia. So I don't know whether there might be a requirement there to do that. In the U.S., the answer is you don't have to report it. There are some times when the auditor wants to see your cost approach, so they want to see your replacement cost first, because they want to know that you're starting at a good point. And again, we're talking about credible results. So some people want to look at that and say, are you doing a credible result? You don't have to report it. At least, again, there might be something there. I never report it, but as part of my cost approach, I do show it to the auditor so they can see the pathway from replacement cost to market value.
Okay, this question we have been received. This question is asked a lot. Is there a best practice valuation report format or a template?
Yes, it's called the International Valuation Standards. It's got, I forget which section. IVS is just, I think, January 1st of next year. I think it's a new version.
Yes.
And shoot, they've moved things around a little bit, and I somewhere, if I can get on my computer, I can tell you where it is. But there's a section on there on what needs to be in a good report. And is it a template? No, but it guides you through what should be in a good IVS report. And between that and again, going back to the valuing machinery and equipment, chapter 8 or chapter 9, there's a whole chapter on there that I was very involved in on what should be in a good report. So.
Okay. Ruka, do you have anything? Because I think we exceed our time. Ruka?
No, I'm okay.
Yeah,
Okay.
we received many questions, but unfortunately we don't have the time to answer all the questions.
Yeah, sure. Some of them will respond to them via email.
Yeah,
Yes,
and so, yeah, we can respond, and some of them were answered during this session.
And if there are questions, you have my email. At least you will have my email. Feel free to email me with questions. I'd be more than happy to try to answer them the best I can.
Okay. Thank you very much, Mr. Douglas. Thank you for your time and for this session. Thank you all members who joined us from Taqeem. Thank you for your time, and have a good night.
Thank you, everybody. Appreciate you spending so much time. Have a great day. Thank you.
Thank you. Bye-bye.